inflation strikes. Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
We intend to increase production at all factories. Affordability is what matters. So as you make the car more affordable, we'll have demand go crazy. The hard part is building the cars. I can't emphasize that enough. The hard part is building the cars and the entire supply chain that goes with the cars. This is a logistics challenge of extraordinary difficulty.
That was Elon Musk there, Tesla's CEO, on Tesla's Investor Day in the last 24 hours. Many analysts disappointed by Musk's presentation.
Disappointed.
Tesla shares down in the pre-market by close to 6%. Dan Ives of Wedbush disagreeing, saying this was a showcase event for Musk and the Tesla community. We maintain our outperform rating, 225 price target, and came away, Tom, very impressed by the Tesla Foundation and Musk vision for the next decade. So there's a bull.
I'm lost. Do we need a brief on this? How much is the average Tesla, John? I mean, when we're looking down the roads that you and I look at.
Depends what features you get on it.
Exactly. I mean, but they're pricey. I mean, the answer is we've learned that EV is pricey, right? We can all go there.
Sure, 50K plus.
Okay. Dan Ives joins us now with Wedbush here on his enthusiasm for Musk Automotive. Dan, I look at the desire for a cheap electric car. Everyone else has the same desire. I'll leave it up to you, Nissan, et cetera, et cetera. Isn't he competing at the low price point with 5, 6, 7, 8 other vehicles?
Look, I mean, no doubt to hit the masses, you need a sub 30K vehicle. I think what Musk showed yesterday in the Tesla Vision is from a production and scale, and they're in Mexico, batteries that I believe could come down 30, 40%. They're now going to be able to hit those and hit the masses. And I think ultimately it's a flex the muscles moment for Tesla, especially with a lot of the industry stumbling.
Okay, well, this is fine, but as John mentioned, and I saw a stream of disappointment over this Investor Day. There was a stream about the Goldman Sachs Investor Day, but it was nothing. What was your take on two guys in black T-shirts up with mics given an Investor's Day? I mean, I don't get it.
Yeah, look, I think these Investor Day, and look, we've seen it with Apple and Cupertino, you tend to come out wanting more meat on the bone. I think for Tesla, as we've seen before, they lay out the foundation, sometimes don't unveil the actual vehicle. And they talked about 2 new vehicles coming out, but the last thing they want to do is sort of, get ahead of this. I think this is something that will be probably a separate event. But I think the foundation to get to 3 to 5 million vehicles and eventually 20 million, it's there. And I think ultimately that's why, I believe along with Apple, the most transformational companies in the market.
Dan, there's been a lot of narrative about how companies are moving their supply chain out of China, including Elon Musk, despite some of his rhetoric supporting the cause in China and supporting his business there. How much credence do you put into this? Is this just anecdotal, specific incidents that don't really move the dial? Or is there a seismic shift out of China to insulate some of these companies from the geopolitical risk?
Yeah, look, normally it's smoke and mirror type beltway talk. I think this is real. In terms of Inflation Reduction Act, there's a real incentive from a tax perspective. That's why you're seeing more and more of a build out in around Austin. I think you'll see more of a build out in Fremont as well. But we're seeing it across tech. I think you're going to see more come to the U.S. But no doubt, right now, and it is for, called the next 3 to 5 years, China is going to continue to be the hearts and lungs of the supply chain. And I think Tesla is just really sort of balancing between China and non-China. That's why you're seeing that build out now in Mexico as well.
Dan, how do you game out the market risk tied to the presence of a lot of these tech companies? And I'm including Tesla in that loosely because it could be an industrial company. How do you include the risk of increasing geopolitical tensions between the U.S. and China, disrupting supply chains, forcing a more rapid shift in some sort of supply chain issue earlier that would cause some of the margins to compress?
I mean, look, just to put it in context, Apple, if they went full in and wanted to move production out of China, best case in the next 3 years, they can move 5% of production out of China. I mean, this is such the hearts and lungs, almost cemented. So it's something where it would take a long time to start to move 5-10% of production. That's why the reality, and we saw it with Tesla and Apple in terms of the zero COVID issues in December. I mean, really at the mercy of China and Beijing for now, although slowly moving, in the opposite direction.
Dan, what were your February channel checks on various and sundry tech names?
I mean, it's holding up much, much better than feared. I mean, even coming out of Asia, not seeing any sort of supply chain cuts for iPhone, which I think is important.
Right.
And I think what you saw from Salesforce and across the board, this is not necessarily the minute that yell fire in a crowded theater in terms of what we're seeing.
Dan, it'd be a crowded theater for some of the parts analysis from you on Apple. Somebody asked on the show the other day some of the parts, and I said I really don't know because nobody wants to mention how high that statistic is. Apple, $150 a share. What's the sum of the parts?
I mean, some of the parts, bull case gets you to 225 to 240. Base case 200. I think the big thing is the services business. I think that's a permanent re-rating that we see there. And now when you start to see more and more, especially with the next iPhone, and you have 25% of the base that have not upgraded, I think there's a stock that's going to have a 2 in front of it this year, despite the macro and obviously many, negative on tech.
Where's the 2 come from in the numerator and the denominator? Just PE or price to cash flow or price to record share buybacks? What drives it over 200?
I mean, it's really services. I believe it's 1.3 to 1.4 trillion. Of course, you have the franchise hardware business, and then you start to look at the capital allocation program. I mean, that's what drives you anywhere from that low to mid 2 level in terms of where I see the stock going.
Dan, just to finish on Tesla, if yesterday was so good, why is the stock down 6%?
I think it's just a typical sell in the news. Street always wants more. Stock sells off, the haters come out. But ultimately, in terms of the path, in terms of record deliveries, where they're playing, I think this is more flex the muscles more. We'd be buying on the sell-off coming out of these events.
What about the Cybertruck, Dan? What's happening with that?
Yeah, I mean, look, I think this is something where by the end of this year, you're going to see ultimate deliveries come out in production, and it's important. And that's why I think this ultimately lays the groundwork for what we see as the next vehicle, from the Tesla ecosystem.
Did you get enough from them yesterday on that release?
I felt yesterday they basically doubled down to that target's going to continue to be there. It's not good. The goalposts are not going to get moved out further. I think a year from now, you're driving around Manhattan and you see Cybertrucks.
Okay. In the wild. Dan Ives of Wedbush. Thank you, Dan. Appreciate it, as always. Stock's down by 6%. What did he say? The stock sells off and the haters come out.
Stock sells off, haters. That's
the
CFA
haters are out
level
this
1.
morning.
CFA
Stock's
level
flying year
1.
to date. Had a really difficult year last year, but it is flying year to date in a major way.
Yeah, it's a beast of its own. Is it a car company? Is it a tech company? What I don't get is, granted, they had the territory to themselves. I mean, John, let's be honest. Lisa used to drive a Hummer. She's gone sensitive. ESG clicked in. She got rid of the Hummer to discount.
Is that what sensitive is?
Taking
on ESG.
What else have I done? Please inform me.
But
I'm just curious.
With the reality Elon Musk has to face, a Nissan Leaf. I mean, even the name says Bramo. A Nissan Leaf loaded goes from 28,000 up to 35,800, and Bramo's got to have the two-tone paint job at $695.
Is that how much that is?
Yeah.
Is that what you've been doing through this segment, pricing up a Nissan Leaf?
Well, Lisa asked me to. But the kids don't want to be seen in it. That's a separate story.
Nissan will love this.
Yeah.
If I sit here for long enough, they'll blame me for the weather. I do think, though, honestly, you're raising a good point. That said, the barrier to entry is so high that the competitors are struggling, and Rivian really highlights that. They are not competing with Tesla, even though there are other entrants.
Agree, but Nissan is not Rivian. Nissan's like a real car company. I just picked Nissan because I thought Leaf fit with Bramo.
This is difficult. This is difficult. They're difficult cars to produce. And to transition the production line from one thing to another is not straightforward. It's hard.
But he's going into competition with how many? 4, 5, 6, 8, 10 vehicles.
He's going into competition with China, and that, I think, is one of the big questions. And for a lot of these companies that are dependent on the China business, how does that get disrupted if you start to see some of the back and forth, the political football in D.C. become policy? And that's really a key question that I don't see priced in or gamed out in any capacity.
Away from the stock, and just to talk about the cars, wouldn't you rather have a Porsche Taycan? Wouldn't you rather have that? I mean, for me personally, that's what I prefer.
Evidently, I'm in a Leaf. That's
well, you can
going
drive
around.
my car if you like.
Thank you.
First-
You don't have to stick them in this. We can share.
First person.
I'll drive. You'll sit in the back.
She's driving a Porsche with Birkenstocks on it. You know, you can just
Awesome.
It's just good to see it.
Luke Howard's coming up next from UBS.
No, I can
Asset
see him in a
Management.
Porsche. Yeah.
I'm sure he's got one. Luke's going to join us shortly. It's that UBS money, Tom. Makes a
Yeah.
difference.
He's driving a Fiat before.
Future's negative. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
DPDHL is sending a consistent message with its investments. The company spent 123 million euros to upgrade its logistics centre at the Cologne Bonn airport, designing it around key strategic goals.
What I love about this building is it actually shows the big mega trends which formed our strategy 2025, which was inaugurated in 2019 when this building opened. So globalization, connecting the world. E-commerce, we have a lot of sortation facilities here for smaller e-commerce shipments. Sustainability, it's a very sustainable building with solar panels on the roof and everything. And digitalization, and well, you can obviously see that it is quite automated.
How did the team pitch this investment to you initially, and how hard was it as a sell for them? How quickly did you turn around and say, yes, this is worth the 123 million euros?
Of course, you always have to make sure that you have the right capacity for the growth in the network. And at that time, they came and said, hey, we will really see a strong growth in e-commerce volumes on top of the regular B2B growth. We need more sorting capacity. We need this building. And of course, there are always debates. Does it really have to cost 123 million euros and so on? But fortunately, they convinced us, because then with COVID and the volume surge, we urgently needed the capacity.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. The top names at the Fed are on Bloomberg.
Inflation's normalizing, but it's coming down slowly. I just think there's going to be a lot more inertia, a lot more persistence to inflation than maybe we'd all want. I'm hearing people still out there pushing price and trying to test where the levels of inelasticity really are. As the meetings go on this year, we'll see what happens. If inflation settles, maybe we don't go quite as far, but if inflation persists, maybe we'll have to do more.
Nobody covers the Fed like Bloomberg, your global business authority.
Central banks had hoped that by now there'd be clearer evidence of services inflation easing off, but that just doesn't seem to be happening.
I'm not sure necessarily we're going to be getting back to an expansionary environment just yet.
The trade into what we'd call more cyclical parts of the market probably happened too fast, too soon, earlier on this year.
We're still going to see prices going up here. That's the main event.
I'm still medium term of the opinion that this monetary tightening will see the economy suffer in the future.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
We've got a 4 handle on a 10-year in the United States of America for the first time since November. Live from New York City this morning. Good morning for our audience worldwide on TV and radio. This is Bloomberg Surveillance with Tom Keene and Lisa Bravitz. I'm Jonathan Ferro. Futures trying to stage a recovery here, down 1/3% on the S&P 500, but front and center inflation, Tom, around the world looking stickier.
I'm going to go back to December of 2007. Granted, we had a spike up here recently, but if you do a quarterly chart, a broader, longer chart of the U.S. 10-year, you have John Taylor's great moderation, great disinflation, down we go under 1%, and the spike up. Now, I haven't done the math work yet, but what we've got is yields back to where we were near August of 2007.
The numbers speak for themselves. Your 10-year just north of 4% at the moment. In the last 24 hours, we had a little look at 4.90 on a 2-year, getting closer and closer to 5%. That's the bond market. Some retailers out with earnings this morning. A little bit earlier on, we heard from Macy's. Lisa, what have you got?
Okay, so Best Buy comes out, and here's the confusion that really makes it difficult to understand the earnings. Talk about market reaction. Give you the data. How does the market react? Macy's gave a downcast forward look, and their shares popped. Best Buy gave a lot of positive data. Their earnings per share in the fourth quarter, 7 cents versus an estimated 2.6 cents. They talk about how just in general, revenues came in strong. You saw gross margins come in at 20% versus the estimate of 19%. Those shares down by 1.5%. So here's the question, right? What are people looking for? They're looking for forward looks, and how much can you kitchen sink it at this moment in terms of the potential negativity going forward?
The forward look from Best Buy at the moment, they offer a range for the full year for revenue, 43.8 billion to 45.2 billion. The estimate was 45.74 billion, so a touch lighter there. For full year adjusted EPS, the range they're looking for, 570 to 650. The estimate there, 675, so a touch light on that one as well. Best Buy in a pre-market, at least no real drama. We're down about 6 or 7 tenths of 1%.
Which highlights, again, how many more companies are going to come out and try to give the most downcast view that they possibly can. And is the market looking past the downcast by saying that simply this is a messaging exercise by executives? There also is a story about how there are a lot of different accounting shenanigans going on, or creative accounting mechanisms to try to, goose up earnings that Lou Wang wrote of Bloomberg. And I do wonder,
fantastic.
It was a really good story taking a look at some of the hedging around the margins in terms of delivering some of these beats and some of these projections. I just wonder if people are, giving the benefit of the doubt.
I'm not sure companies want to be associated with so-called creative accounting.
I would agree with you.
At any point.
Yeah, I would agree with you.
Best Buy's down about 1.6% in the pre-market. More retail earnings still to come. Lisa's going to go through your day ahead in just a moment. I'll whip through the price action more broadly for you. On the S&P 500, no real drama, down 1/4% off the back of a day of losses on the S&P 500 yesterday. As one component of some economic data in America speaks to sticky prices, the prices paid component of the ISM manufacturing. So prices paid in the manufacturing sector, just a bit elevated, spooking the bond market. That's why you've got a brand new 4 in front of a 10-year right now. Your 10-year yield, Tom, just north of 4%, up 2 basis points on the day.
Back to 1985, John, and this really gets my attention. I didn't realize it was this bad. The spike up in yields, really carefully done on a log chart, is exactly 4 standard deviations. Luke Kawa knows there's a difference between 2 standard deviations and 4.
We'll get to Luke in just a moment. Lisa, just to finish off with the data we've had so far this morning. Ton of earnings, yes. Eurozone core CPI. Inflation in Europe, record highs, just not what the ECB president wants to see.
And it sort of puts a 50 basis point rate hike as a lock for the ECB, and then potentially another one after that. What we're looking at today are the retail earnings. We've gotten Macy's, we've gotten Best Buy, both giving a more negative projection, more cautious projection for the year ahead, but delivering good fourth quarter results. After the bell, we get Nordstrom and Costco. Here's the question that I have. How forgiving is this market going to be? How much are they going to look past the negativity or the more cautious view for 2023 and say, you guys are just being really prudent in terms of your estimates? You've seen the retailing index really go full circle this year and really end almost flat after 2 tumultuous months. 8:30 a.m. we get initial jobless claims. Do we get a sub 200,000 print once again? People are just not filing for jobless benefits the same kind of way that they have been in the past. And here's the question. Does this indicate some ongoing tightness in the labor market, or is this a broken indicator because of the nature of the layoffs and the nature of the labor market right now? And today the Fed speak includes Fed Governor Chris Waller at 2 p.m., Minneapolis Fed President Neil Kashkari at 6 p.m., Do we get a more concrete sense, John, that a 50 basis point rate hike is on the table for the third week in March? Is that going to be increasingly what people are talking about?
I get a sense from Kashgari's comments this week that he's ready to discuss it. One thing he said yesterday that I thought was interesting and maybe worth watching is that he wants to use the dot plot to convey higher for longer. So I think the median dot, the dot for 23, what was it, 5.1%?
Right.
Something like that. Does that get pushed out to market pricing, which is in and around 540, 550? Did they push that through much of 2024 in the way that Raphael Bostic, the Atlanta Fed, would like to see as well? So that's where the fireworks are going to be, so to speak, I think, when it comes to Fed meeting day later this month.
I love that. The dot plot is where the fireworks
That's
are
where
going
the
to be.
fireworks
Just go
is.
inside, and it's going to be absolutely incredible.
It's hard to explain to people
John knows how I feel.
who don't follow this that the summary of economic projections could be somewhat market moving and exciting.
Actually, it could be tremendously market moving. To your point, you're not wrong. It's just that,
Yeah,
say
I
like
know.
that,
I know.
I think it's fantastic.
I always say, if you accidentally tuned in to business TV, radio one day and heard some of these conversations, you'd be like, what on earth is this all about?
No way.
Luke Cower joins us now, Director of Investment Solutions over at UBS Asset Management. Luke, wonderful to catch up with you, sir, as always. Let's just start with the outlook for 23. You came into a new year and you just nailed it. You said you think the global economy is going to be better than people think it will be. You said that the economy will be more resilient. The data speaks to that, Luke. Can you just frame for me how difficult it's been to get the market call right off the back of that, given that we had two very different months to kick off 23?
Well, yeah, I would say the thing we overlooked there in kind of putting out a more optimistic economic view and how that would map onto markets was, I guess, the extent of the pessimism on the U.S. and the fact that, effectively January and through the first and through most of February as well, you got data that was, incredibly U.S. centric and strong, and that contributed to a move in the dollar that I think undermined the positive global nature of the story. The fact that, it's not just the U.S. pushing back recession date because the labor market's so tight. It's the fact that, 2023 is also the story of, headwinds from 22 turning into tailwinds. And, the most important fresh one of those is China. And we think just as much as,
Right.
February, the first half effectively of the first quarter of this year was all about U.S. centric strength, that the second half of the first quarter is going to be, all about acknowledging the strength of China's rebound.
Luke, young Turks like you, prodigious in mathematics and dynamics, have never seen these rates, including the 4 standard deviation U.S. 10-year move I just mentioned. When you talk to the Ute of finance for UBS, how do you frame the new regime we're in, which begins to harken back to the pre-2006 regime?
No, we love it. Multi-asset portfolios, giving us a yield where, we're able to count on possibly, yield at the long end, the possibility of capital appreciation, but also these yields on the short end from portfolio construction standpoint, especially if you kind of have the view as we do that, stocks are very expensive, particularly U.S. stocks, but that the labor market's preventing kind of a credit cycle. Well, in that case, you see what's going on with USIG at the front of the curve, and you just say, hey, that's a very, very attractive opportunity. So, in terms of what we do, having that option with yields being where they are to build better portfolios, help clients meet goals a little easier after what was a tough 2022 all around in markets, we'll take it happily.
How hard of a sell is it, Luke, to say go buy Chinese equities?
The reason why it's so hard of a sell is kind of why we can argue why there's opportunity. I think the fact that Chinese equities have for a large part of time been the kind of proverbial Lucy taking football away from Charlie Brown there in terms of kind of gutting people as soon as a catalyst becomes apparent. I think that's why we see so much opportunity, and it's because it's the suite of policy catalysts lining up. It's the fact that I think Evan mentioned it the last time he was on with you. We think President Xi can largely achieve some of his goals. For the past 3 years, those goals have been very disparate and not related to economic growth at all. It's been reeling in real estate. It's been controlling the technology, the power of internet platform companies. It's been controlling the spread of COVID. Now all of those kind of boats are lined up in the right direction for growth. So the fact that it's just this multifaceted suite of policy changes that are more pro-growth is, I think, something that makes the sales pitch a little easier this time around, because everyone can see how stark the policy shift is along these different lines.
Look, for a long time, the US-based investor hasn't needed to look abroad because things have been so great here at home, particularly with the big tech players. Luke, as they look abroad now, don't worry about it, Luke. It's all right. Dogs happen. They bark. We can talk about your dog in a moment. I want to squeeze this question in. Lucas, they look abroad at the moment and maybe look to invest abroad for the first time. How do they manage that currency risk?
On currency risk, I think that's the kind of one thing on a tactical basis and on a strategic basis where, a lot of the stars will be aligning in the same direction. If you talk to, the folks who put together our longer term capital market expectations, and I would say even across the street, a lot of those strategic asset allocations model have the, dollar is very rich, needing to mean revert. So from that perspective, it's going to be, effectively an additive to returns going forward. Then on the tactical basis, what we've seen in, effectively the source of what's given the dollar this latest leg higher, it's, the terminal rate, which was in a 15 basis point range around 5% for 4 months, broke out to the upside. So, you have to say, okay, well, we're going to 5.5. Are we going to have the same move, though, in the terminal rate that we got through all of 2022? And, our answer to that is no. There's simply not going to be that kind of momentum. So in terms of real rate differentials compressing, in terms of real economic outcomes compressing, and very importantly from the equity standpoint, in terms of real earnings rates compressing. The biggest difference between this cycle and the last one, in our view, is that the reliability, the lack of volatility in high-tech earnings, as well as their premium growth rate, it just isn't going to be the same. That's your call to go outside, to go to foreign markets.
Now we've got to squeeze this in. Luke, we all just want to know if the dog's long the euro. 1 bark for yes, 2 for no. There we go.
There he is, long
There we go.
euro.
So long the euro.
Yeah.
Hey, Luke, that was awesome.
Hug for us.
That's
Luke,
fantastic.
of UBS, right on cue. Was that 1 bark or 2?
That was 1 bark.
And then it came in with another
It was
one.
like-
So it's just like
well, it's
yes,
just like
yes,
yes, like yes, it's
nice.
yes, yes.
That works. We should make a show out of this.
I think that we will.
All right, next down, Liz Young of SoFi. Looking forward to that conversation a little bit later. Futures down 1/4%. This is Bloomberg.
Gotta love that. Keeping you up to date with news from around the world with the first word. I'm Lisa Mateo. Inflation in the euro area fell less than anticipated last month, and the underlying price pressures rose to a record. That reinforces expectations that the European Central Bank will have to raise interest rates again. Consumer prices hit 8.5%. Core inflation, which is what policymakers are focusing on, rose 0.3 of a point to 5.6%. The Biden administration is on a potential collision course with big tech companies. It's coming out today with an aggressive new cybersecurity strategy. The plan seeks to shift the blame from companies that get hacked to software manufacturers and device makers. The process will require Congress to pass legislation. In the UK, Conservative lawmakers say former Prime Minister Boris Johnson's prospects of returning to power have been killed off. The reason? Rishi Sunak's success in securing a new settlement for Northern Ireland with the European Union. Johnson had refused to back Sunak's efforts. Shares of Macy's are surging today. The department store operator reported better than expected fourth quarter earnings and comparable sales. Plus, the midpoint of Macy's full-year forecast beat the consensus. And it's the starkest warning yet from a U.S. bank that caters to the crypto sector. Silvergate Capital says it needs more time to assess the extent of damage to its finances stemming from last year's crypto rout. That includes whether it can remain viable. Shares are plunging in pre-market trading. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
So you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
From the world of politics to the world of business, Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg. From our studios in New York and San Francisco, our new hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech at a new time, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
We raised our dividend. We're investing to grow. Last year was our largest U.S. production ever. The Permian's going to grow another 10% this year. The balance sheet's very strong, and the cash that we have surplus to that, we've always distributed back to shareholders through a buyback. The company's stronger today than it was just a few years ago, so the numbers are larger, but the approach is very consistent.
So the White House has not called you yet?
I haven't gotten a call.
A fantastic exchange there with Alex Steele and Mike Wirth, the Chevron chairman and CEO. Live from New York this morning. Good morning. Second day of March. Equities doing its thing. Lower, down, negative a third of 1% on the S&P 500, adding to the losses from yesterday. Sticky inflation, a theme worldwide. We saw the prices paid component of the ISM manufacturing survey here in America elevated. To add to that, as expected, really, Eurozone core CPI, all-time highs. Yields on a 10-year. Get used to this, maybe. I say maybe because who knows, given where the price action has gone so far year today. 4%.
Why should it stop here?
On a 10-year. Well, at the end of the day, the market's priced in a higher terminal rate, Tom, of, say, 550.
Yeah.
Let's see. There are some people out there who thinks this data can hit an air pocket in the next couple of months, and we'll find out.
Yeah.
I'm not taking a view. I just can't take a view in the other direction either.
I actually think that you could make an argument, and I understand when people say that you're close to the peak in the 10-year, just simply because if you end up with central banks doing more now, you have to imagine that's going to have consequences longer term, right? I mean, you have to imagine that's going to diminish some of the growth longer term. So the more hiking that you bring into the front, the more you could see that 10-year potentially move, unless we're in a completely new regime.
That's the other side of the debate. I think what's fascinating about this moment, just in terms of inflation expectations building again, it's happening without a rally in Mike Wirth's world.
Yeah.
It's happening with crude flat year to date.
And Mike Wirth was talking about China and how the sort of resurgence of China was going to cause a pop in oil prices. We've heard this before. Where is it? We're not seeing it.
To go all Elarian on you, and I jest, but Dr. Elarian is truly expert at the game theory of this. The unknown unknowns out there now are unquantifiable. And what I find interesting, John, is the financial analysis of standard deviations and trends and vectors and all. But nobody's talking about the asset realities of that, the new world we're in now, 7% mortgage, or where we could be in 60 days. No one's talking about what it does to assets.
So Mohammed put out a piece on Bloomberg Opinion this morning, super humble about the fact
I did not read it, Mohammed. I'm sorry.
Well, I've read it. He said the following: it's no longer crystal clear to me what the right policy step should be now. I suspect I'm not the only one. He was pushing for a 50 basis point move at the last meeting. They didn't go in that direction. He said this, though, and this is brutal, this line here: a multi-stage policy error in which the Fed first mischaracterized inflation as transitory for a protracted period, moved too slowly in adjusting policy once it had retired transitory from its vocabulary, and then fell behind the policy challenge for a third time by downshifting its increases too quickly. Caught up with Mohammed this morning. He reminded me of a note that Mike Gapin of Bank of America put out on February 7th after Chairman Powell went down to the Economic Club of Washington. Do you remember that? And Mike Gapin put out a note and he said, Volcker's left the building. We're not in Wyoming anymore. That was the takeaway. And that's, Mike Gapin was right. That was an accurate characterization of what Chairman Powell had delivered in the news conference in Washington, even after the big payrolls report, where he was still embracing this whole disinflationary process has started stuff. And that just feels very foreign now, just 3 weeks later.
Do you think, in retrospect, and I'm wondering if we can reframe this debate, that policymakers will look back and say that they should have been more aggressive, even at the expense of the economy, because of the stickiness of inflation, right? I mean, is that basically what people are trying to say, that they should have gone further because they've raised rates a lot? I mean, it's not like they haven't been aggressive.
These guys don't live in the hindsight world. I mean, they're data dependent, and the data is Dr. Larian mentions, has been grim. And you know, I'm going to say, John, what I said at the top of the show. I'm looking at a Bloomberg screen I've never seen before. That's a fact.
I think we do have to go over this, Tom. There was two risk around the inflation story. They acted in 2021 as if there was only one.
Right.
We had a guest on about an hour ago, Dean Kernet, who said back in August of 2021 that inflation is transitory as the new subprime is contained. That was August of 2021. 12 months ago, March 2022, rates were still zero, and they were still doing QE. So when Mohammed talks about a multi-stage policy error, it's not just about the mischaracterization of inflation at the time through 2021. It's how slowly they moved to start hiking. Now, I hear all this stuff about how they front-loaded. Yeah, I mean, they front-loaded, but they were playing catch-up. They were playing aggressive catch-up because they were so late to move.
It's a really important point. And when you talk to executives of banks and other companies, they say this was the fatal error, was not raising rates sooner in 2021. And a lot of them have this concern that it was political because Jay Powell wasn't renominated yet and didn't want to make an aggressive move because of that.
John, the politics this morning is the politics this morning. So we're reporting that U.S. Secretary of State Antony Blinken had a brief encounter with his Russian counterpart, Sergei Lavrov, at the G20 foreign ministers meeting. Tom, Blinken's message to Lavrov was to urge Russia to re-engage on the New START treaty, release American Paul Whelan, and engage with Ukraine on a plan for peace. That's according to a U.S. official speaking to reporters. So that happened, that meeting happened briefly.
Well, let's go to that. I mean, we can change the news on a dime, and we can do that with Anne-Marie Horton, our Bloomberg Change on a Dime correspondent. Anne-Marie, good morning. You know the Lavrov-Blinken nexus like nobody I know, this with all your work in Russia over the years. Not that they're friends or frenemies, but what is the relationship of the two foreign policy leaders?
Oh, this relationship is deeply fraught. They haven't met formally since this very brief encounter. I mean, it's under 10 minutes. This encounter on the sidelines. I mean, the Russians aren't even saying that this brief encounter even qualifies as a meeting or even talks, which is why I guess they're using this word, quote unquote, encounter. But what we are hearing from the State Department, from senior U.S. officials, is that Blinken had this frank conversation about these 3 points Jonathan just outlined. One, about re-engage in New START. We want Paul Whelan back. And also that you need to start discussing peace plans. You need to get out of Ukraine, as well as a message of we will stay with Ukraine until as long as it takes.
What's the takeaway, Anne-Marie, that there was no memo out from the G20, no rhetoric agreed upon to characterize Russia's war in Ukraine?
Honestly, I'm not surprised. Finance chiefs and central bankers also met at their G20 meeting last week, and there was also no joint statement, just this document from the chair. What is happening is you see a reversal from China and Russia on language that they were able to agree upon in Indonesia at the Bali G20 summit in November. And India officials have really been trying to avoid the use of the word war, or there's debate on do you call it Russia's invasion of Ukraine or Russia's war in Ukraine or just, quote, war in Ukraine. A lot of this is semantics. Obviously, it is Putin's invasion of Ukraine. But what is key here is that the G20 will be overshadowed by this issue. And this is going to mean that, especially the global south that are really struggling with things like food insecurity and energy prices, India wants these major issues to play a role. And I imagine that when they do meet at the ministerial level, the leadership level for this G20, Ukraine is obviously going to dominate, but not just what happens next. It's going to be about things like this. What can all these 20 nations agree at even calling this conflict?
They can't agree on much right now, sadly. Anne-Marie, thank you. AMH on the latest. Remember that phrase from Ian Bremmer that he made very popular, G0, never mind G20. The latest from the G20, the foreign ministers meeting then. Blinken, Secretary Blinken, the Secretary of State here in the United States, had a brief encounter with his Russian counterpart, Sergei Lavrov.
Well, I mean, there it is. It's got to finally be one. And there's three items you mentioned, and all three, I have to believe, are complete non-starters right now. But what else do you say? You've got to identify your parameters, as I'm sure Mr. Lavrov did as well.
How do you engage on a peace plan for
We're
Ukraine?
at war.
When
This is,
ultimately...
again, I really take issue with this. There's a war going on. I mean, that's the end of the discussion.
Is there a discussion over territory and giving up some of the territory?
Some would like that.
Ultimately, some people would like that. Ukraine, for them, it's a non-starter.
I saw a map the other day. I think Ben Hodges, the great general, had it out on the missile ranges that Ukraine's going to have. I mean, they have a reach now they didn't have a year ago.
Equity futures right now down 0.4% on the S&P 500. If you are just tuning in, stocks a little softer. We're negative this morning. Yields a little bit higher, 4% on a 10-year in the United States.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right, I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Equities this morning, good morning, negative by 1/3%, negative 0.4% on the S&P 500. We're negative 0.6% on the NASDAQ. And this equity market has to compete with this. In the bond market, a 2-year, a 10-year, that looks a little something like this on a 2-year through 490 in the last 24 hours. Right now, just south of that, at 488.92, yields up a basis point. At a 10-year with a 4 handle, 4%, yields higher there by 3 basis points. Inflation looking stickier on the United States. side of things, on the European side of things, Eurozone core CPI, all-time high. Had a strong steer into this through the week as you've got a breakdown of German CPI, France, Spain, Italy, and all the above. This is looking sticky. The ECB is going to go 50 and maybe 50 again after that. That's going to be the debate, Lisa. Euro dollar 106.24.
And if the ECB has to go more, does the euro weaken more? I mean, honestly, this is a serious question. I'm curious about, did you find that surprising at all, John?
We'll go back to the 2nd of this month. I think the high was 110.33. We just heard from Chairman Powell. He was embracing the disinflationary process and all that good stuff.
I think that died a while ago, though.
Yeah, you think?
Anyway.
And then we got the payrolls report, and it was dollar strength ever since. And I think we got as low as 105.33 on euro dollar from there. So we've come down from 110 to 1.5, and we'll see where we go from here. The question I've been asking over the last couple of days, you've now got basically a peak rate being priced in at 4% at the ECB, 550 plus maybe at the Federal Reserve, trying to work out what's more achievable. And where does the upside surprise come from? Europe or right here in the States?
It was a good question. 4% for the ECB or 6% for the Federal Reserve. Taking a look at some of the retailers, there is one theme, a cautious outlook going forward. There have been beats in the fourth quarter. The response in markets is fascinating. If you take a look at American Eagle, which yesterday reported earnings taking a cautious view for the year, but seeing some positive signs of normalization. Those shares up 4% ahead of the open. They're concerned about consumer spending, blah, 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 macro, and that's what people heard. And they still are seeing some positive signs of that. Macy's, same kind of story. They came out with a conservative look, but seeing the potential to clear through some of the inventories and still post some decent growth. Those shares up 9.2%, blah, blah, blah. People looking back at macroeconomic worries. Best Buy, a different story. And this is interesting. This shows how the kitchen sink story doesn't always work if your fundamentals don't bear it up. And this is what we're seeing with Best Buy. Soft sales and earnings guidance for the fiscal year. They beat in the fourth quarter. And those shares lower by 2.4%. It just highlights that macroeconomic doesn't cover the idea of negative sales growth for many consecutive years and idiosyncratic issues facing companies. For example, in the consumer electronics space, where they face a lot of competition online and in others.
I love the way Lisa does this. If the stock is up, American Eagle up 4%, it's blah, blah, blah. Macy's, blah, 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 it's up 9%. But here's the real deal. The stock that's down, Best Buy, by 2.4.
Okay, no.
You should edit press releases. That would be great.
Hold on a second. Let's just be real honest, okay? The macroeconomic headwinds is a catch-all phrase, right? And when you look at that and then you see the shares pop, you have to think people are reading that as blah, blah, blah. You're putting that in as a way to basically hedge everything and then throw in anything negative and then show strength, right?
I would go to their income statement. They're on razor-thin margins. If they have revenues, either unit-driven or price-driven, flat to down, John, at the bottom of the income statement, the math doesn't work.
Well, Lisa covered that earlier with Macy's.
And
Was
blah,
it the
blah, blah.
merchandise margins?
Yeah, well, basically they had to cut a lot of the prices, and so they had to clear it out. But they've cleared it out, and that's the goal, is that if you clear it out, then you can get those margins later on.
Get it out the door.
Yeah.
I'm told the wooden escalators are
still present.
Yeah, I mean, from stories a year or so
I think
ago. So
we should take a road trip.
You can take Tom. I'll give that a miss.
I won't wear my heels.
The big debate. That's some good advice. The big debate over at the ECB, 50, and then 50 again maybe. Over at the Federal Reserve, they went 25 last time around. There are a couple of officials who thought they should have maybe gone 50. One of those who considered that was the Minneapolis Fed President, Neil Kashkari. Here's Neil on the Fed's next move.
I'm open-minded at this point about whether it's 25 or 50 basis points. To me, what's much more important than whether it's 25 or 50 is what we signal in what's called the dot plot.
And that's going to be the focus of the Fed's next meeting. Porrick Garvey of ING warning against accelerating hikes, writing, quote, the Fed needs a degree of underlying stability in order to be in a position to tighten. So upping the size of hikes, Tom, here would be counterproductive. He's not the only one taking that view.
Yeah, I mean, I'm going to go there. It's not my opinion that matters, but this idea of Greenspanian measured versus a Burnsian jump condition in central banking is raging here at these new levels. Porrick Garvey is with ING, and he brings to them prodigious econometrics as well. I'm going to go to the econometrics of the moment. And really within that, in the shock of all the fancy mathematics you deal with on debt and central banks every day, what's the overcome by events thing you worry about out there? What's the OBE out there that we need to pay attention to?
I think you've got to look at the shape of the curve, Tom, to understand that this is a really unusual set of circumstances.
Yes.
We haven't seen the degree of inversion that we're seeing now in the past 4 or 5 decades. And that tells me that the back end of the curve is pricing in a huge degree of uncertainty. I'm not convinced it's entirely the rate cut narrative. I think there's a bit of geopolitics out there. I think there's the reality that the central bank is holding lots of bonds out there. And I think there's anchoring. I have this conversation with traders all the time. They say, oh, we think the 10s are going to go back to 2%. And I would say, why? And they say, well, that's because that's where it was. We're not going back to where we were.
Okay, I meant this is brilliant, and there's a lot to unpack there, and we don't have the time to do the unpacking today. We'll do our Fibonacci later. The bottom line is we had a 4 standard deviation move off the Great Moderation going back to 1985, and that's part of that yield curve spread. And if I look at 2 years compared to 30 years, as you say, truly we're in new territory. Does it signal depressed growth or a duration of subpar economic growth?
I doubt that very much, and here's why. If you look at where neutrality is, I would suggest neutrality is around 3%. Why 3%? 3% is 2.5% inflation, 1% real yield, and if I look at the back end of the curve, it's not discounting a break below 3. That's hugely important for me. So I think we've had this unprecedented degree of monetary tightening. It still, in absolute terms, leaves us at approaching 5.5%. Big picture, that's not huge. We've come from 0 to 5.5, but not huge. If we get there and we're done, and the next move is down, and let's suppose the Fed gets down to 3%, that's a very tolerable outcome, and it doesn't suggest anything like what you've just described.
Parag, with the balance of risks, which do you think is more concerning? The risk of inflation persisting at a higher level, or the risk that rate hikes could really kill the economy?
The former is the biggest risk, but I think the way the Fed is pursuing policy here is kind of smart. I know the Fed gets a hard rap because of missing the early rate hikes, but 25s from here is quite smart. They got to keep on 25s and level off. And at a certain point in time, this degree of tightening has got to hurt. You look at lending standards out there; they are as tough as they've been since the great financial crisis.
But we're not seeing that in the data. And this is really the concern that's causing a lot of people to rethink the balance of risks once again, the sort of, schizophrenic nature of disinflation or not. How much do you look at the recent data and the stickiness of inflation and start to question your thesis and start to question if perhaps it's not really restrictive if you look at policy rates right now?
Yeah, you're right, Lisa. We're not seeing it in the data for January. Potentially for February. There's a weather impact there. There's a seasonal adjustment factor there. If you stand back and look at the direction of travel for the data over the past year, we are seeing the impact. With the exception of the labor market. The labor market is where we have this remarkable anomaly where we still can't get people to work, which is incredible to be in that situation right now. That is going to creep, though. You've got to remember that the replacement number in payrolls is 150. Once we get to below 150, we're in growth recession territory. If we go mildly negative, we're in recessionary territory. We don't have to go to a deep recession territory, but the indicators are we're heading in that direction, and it'll be over the next couple of quarters that we see that come to bear.
If you want a sneak peek of payrolls for next Friday, not this Friday, but next Friday, the estimate so far 220. The previous number 517. I'm not sure what the estimate is worth at this point, and I'm not sure what the previous number is worth either, because we could have some monster revision in one way or the other. So I won't put too much weight on that. Parag, I think there's something I'm going to walk away from this conversation with from you. We're not going back there. There's still a lot of people who think we're going back there. And if you look about the arc of like the last 12, 18 months, it was we can't live with 2%. We can't live with 3. We can't live with 4. We're about to live with 5. What is it that's changed, do you think, in this economy that maybe people haven't grasped? The people that are sitting there saying, we are going back there, what don't they get?
We also can't live with 5, by the way. 5% is not an equilibrium, and the equilibrium is down at 3. this is a really unusual set of circumstances, John. I mean, there are so many anomalies here relative to previous cycles. I think people are not getting a lot of stuff because it's tough. It's all over the place, and it goes back to the inversion of the curve and how unusual that is. And I would say the other big anomaly out there is how calm. Well, I won't say it's an anomaly. It's a positive thing. How calm the system is. You look at where banks print CP, very tight. You look at where credit spreads are, very contained. There's very little concern about anything breaking. So when I say we're not going to go back there, show me a reason to go back there. Something's got to break. And so far, something hasn't broken. And until we get that, you know, I think up to 5%, down to 3%, it's a pretty tolerable outcome. It includes a bit of a growth recession, but not Tom's description of
not Tom's doom
Armageddon.
and gloom and Armageddon. It's been a surprise to us all, to be honest with you, particularly in Europe, not just the United States. Lisa, we've talked about this, just the idea that we're now talking 4 in Europe, and the Italian bond market spreads there are still pretty contained relative to the wides we saw last year.
Which suggests we can live with higher than 2% in terms of what that terminal yield could be, as Park was saying.
And we're not going back to zero anytime soon.
People say that, but have they really believed that in the
There's
actual
a lot of
market
people
action?
out there that believe we can go back to pre-pandemic trends. Low inflation, low growth,
not negative
low
yields.
interest rates, get along big tech. A lot of people that still think that. Parag, this was great, just awesome. Come by more often. Parag Garvey there of IG Financial Markets on this debt market. Your debt market this morning, 4 handle on a US 10-year for the first time since November. Very briefly, 490 on a 2-year. And that's what this equity market's got to compete with. Equity futures right now down 0.4%. Coming up on the retail earnings from this morning so far, we'll catch up with Chuck Grum, the senior retail analyst at Gordon Haskett. That conversation is coming up next.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. SpaceX launched a 4-person crew to the International Space Station early today. It includes 2 Americans, a Russian, and an astronaut from the United Arab Emirates. They'll arrive at the space station on Friday and stay there for 6 months. It's the first victory for Republicans in their crusade against so-called woke capitalism. The Democratic-led Senate voted to block a Labor Department rule that allows retirement plans to consider environmental, social, and governance issues in their investment decisions. President Biden's expected to veto the measure. G20 foreign ministers meeting in India have failed to agree on language to describe Russia's war in Ukraine. Instead of a formal joint statement, the diplomats will release what's being called an outcome statement. The same thing happened last weekend at a meeting of finance ministers. Both Russia and China objected to the use of the word war. Best Buy is predicting that sales will fall for a 2nd straight year. The consumer electronics chain came out with a forecast that missed estimates. High inflation is forcing shoppers to think twice before buying televisions, computers, and appliances. In most U.S. cities, homes are still selling faster than they did before the pandemic. That's according to Realtor.com. The firm found that the typical U.S. home sold last month had spent 67 days on the market. That's 20 days faster than in the years before COVID. Still, areas such as Las Vegas, Phoenix, and Austin are seeing homes sit on the market longer. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
So let's go inside the boardroom. Let's suppose you win a proxy fight and or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with the plan.
Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Our clients actually are doing relatively well. They have restructured. They are more cautious, of course, but they are not concerned about the future. Once the consumption will start to decline because consumers will have to adapt to higher energy prices and will not have the savings accumulated from the past, at that point we will see a sharper slowdown.
Lorenzo Benismaghi there, the SocGen chairman, knows a little something about the European Central Bank as well. From New York, here's a sense, a flavour of things as you wake up this morning. We're down just a little bit on the S&P 500 by 0.4%. In the bond market, we're looking at levels at the front end of the curve we haven't seen since 2007, a long, long time. We haven't seen this level on a 10-year since November. 4-handle on the 10-year, Tom, 4.03%, up 4 basis points on the day. Your next stop, jobless claims, about 43 minutes away.
Well, the next stop, jobless claims, but based on the 10-year yield, maybe the next stop is, what are we going to say, 4.10%? I've got two standard deviations of 4.11%. Maybe that's the next stop. What's important there, and you mentioned Benismaghi, he is truly one of the best in Europe. And with that brilliant conversation we just had with Pork Garvey, that's the kind of tone that's making Benismaghi lean forward right now.
What was interesting about what Porek had to say, it's not about where we're going to end up, peak rates, all of that stuff. It's about what we're not going back to. And he doesn't think we're going back to sub 3% on Fed funds. And Lita and I were talking about that. There is still a cohort of investors, Tom, that are waiting for that moment. That's why he thinks, looking at the 10-year right now, does the 10-year make sense? Down here near 4? I mean, possibly, but there are some people who think it should be even lower because they think, Tom, we can't stay in this world for very long. He's saying you can't live with 5, I get that, but he's ultimately saying the range is 3 to 5, it's not 0 to 2.
I'm going to be honest, to me it's an arch theme, say to the next Jackson Hole, is what is the great moderation? Have we broken out of it? Are we to something new? Or as he alluded to, are we to a new great moderation that we've heard from Adam Posen, Olivier Blanchard, and frankly many others? These bankers with their public faces, they have to consider that even if they don't talk about it.
Has the Kansas City Fed got a new president yet?
I don't think so.
No, I don't think
Graham was on the short list.
We're waiting for a new Kansas City Fed president to nail down the dates for Jackson
Exactly.
Hole,
I've been looking for what the new dates
I've got
are.
no
I can't
idea
say.
what August looks like, but apparently the Kansas City Fed doesn't either because they don't have a president yet, Tom, as far as I know. Mike McKee's going to correct me if I'm wrong, but last time I looked.
Well, he'll be the first to know. He's got a real commitment to that meeting. What we're going to do is drive forward the conversation here, and the focus, as Lisa's mentioned, is retail America. The real focus is how narrow those margins are. Joining us is someone deeply experienced from the Stern Agee days with Gordon Haskett. Chuck Crom joins us now to say senior retail analyst barely describes it. Good morning. Chuck, I want to cut to the chase. These guys are not luxury goods makers. They're working on almost grocery store margins. If they have revenues flat, either with unit differentials or price differentials, do they survive? How do they create profit if they don't have the old revenue growth?
Well, right now it comes down to inventory management at Macy's, and that's really what's setting the company apart from its peers, whether it be Kohl's or Macy's. Inventories were down 3% to end the year. They're expecting that trend to continue.
Yeah.
So as long as Macy's can continue to manage their inventory effectively, we think they can hold margins up.
They can hold margins up, but if you look across the pantheon of American retail, and granted, there's problem children like Kohl's, and maybe you put Nordstrom's in there. I'll let you decide who's good, who's average, who's better. They just have historically low margins. How do they maintain that given this environment?
Well, like I said, it really comes down to inventory management. It comes down to managing your sales within your store effectively. Historically, the operating margin profile of the business has been low. That's probably not going to change. You're looking at a low double-digit EBITDA profile for Macy's. Not tremendously different than than in the past. But today we're excited about how they exited the year from a top line perspective, and the guide for 23 looks appropriate from a top line perspective. They're forecasting comps down 2 to 4%. That looks realistic. I think the surprise and why the stock's up pre-market is the EPS guide for the year, which is better than I think people were anticipating. And when you unpack the line items that they're giving us, it's really on the gross margin line, which again comes back to the fact that their inventory levels are clean.
Chuck, do you think that this will be the quarter of house cleaning, of basically kitchen sinking any potential risk, putting it out there and giving a more negative forecast, that stock traders know this, they're going to look past that and see the glimmers of hope beyond any kind of caution?
Yeah, that's actually a great point. And that's what we've really seen over the past week from just about everybody. If you look at the guides that these companies have provided, and take it like Kohl's, for example, are meaningfully lower than the street. Now, Kohl's is a little bit of a different animal right now, but by and large, what companies are doing is guiding conservatively. Now, we're also seeing a deceleration in trends in the month of February, and there are a lot of unknowns coming in March, largely the reduction in SNAP, lower tax refunds year over year. And let's face it, you guys are alluding to the inflationary pressures in the consumer right now, and they're not going away anytime soon. So we're not clear sailing, but we do like how these companies are positioning 23 guides so far.
Chuck, I have to go on a bit of a tangent because yesterday we were talking about how certain brick and mortar stores are being used as return centers for online purchases. And I'm wondering, from your perspective, do you start to see that kind of activity at certain storefronts, that basically they're used as the receptacle for packages and not necessarily as basically storefronts in sort of a way, if they haven't fashioned themselves after that, if they haven't fashioned themselves as an experience?
To a degree. I mean, Kohl's a couple of years ago, if you remember, they linked up with Amazon to do Amazon returns. Target the other day announced plans to start to accept returns at Drive Up. So I think what retailers are trying to do is drive traffic into their stores by all means possible, whether it be a Starbucks at a Target or an Amazon return at Kohl's. Just getting you into the store is an important part of the business, and that's really been the case over the past couple of years, with digital becoming such a large part of total retail sales.
Do you expect consolidation this year, Chuck, given the fact that the winners are continuing to consolidate their power and the losers are looking weaker?
Yeah, I mean, we've already seen a couple bankruptcy filings. Party City, there's a lot of talk about Bed Bath & Beyond. So the winners are going to continue to win and get stronger. And some of the weaker businesses are going to get exposed. And that's kind of what happens in cycles like this.
Chuck Grom, fantastic as always, sir. Chuck Grom there of Gordon Haskett on the retail sector. Good to see you as well, sir. Looking at this in a bond market, can we just get this up just quickly? Have a look at the 2-year, the 10-year, the 30-year. The 30-year, just seconds ago, 4%. Just seconds ago, for the first time since November. Right now, 399.82. Your 10-year, north of 4%. Your 2-year, back through 490. There is a lift right the way through this curve. Once again, Tom.
I'm doing it up right now, John. I'm doing some fancy math over here in a 30-year bond. I've never done this before. It truly is, John. It's just, I can't begin to say how unusual this is. The 30-year is out 3.7 standard deviations, which is completely unimaginable to Port, Garvey, Bramo, you, me, anyone. But what's important is the previous surge was only 1.3 standard deviations. I've never said this word, we've exploded up in yield. It's there, it's on the screen.
Over the last month, in a major way. Lisa, particularly at the 2-year, you take the 2-year piece of things at the front end, came really close to 4% in February, and now we're looking at 5.
Port Garvey's point was really salient here. If we're not going back to 2% and we do go back to 3%, does that mean that a 4% 10-year yield, a 4% longer-term U.S. borrowing cost is the right one, right? And this is sort of a reset, because remember, even 6 months ago, we were talking to people who thought of, any kind of sell-off you buy, because essentially they're going to go down back to the point that they were before. Are we reaching a new realization in markets borne out by this price action that this is a different era in a new way, and it's going to be a decades-long era?
The comfort feature here is we weren't at 2%. We had a huge run rate below 2% within the Fed dialogue. Now we've come out over that, and John, I'll let you decide if the new 2 is 3 or 2.8, whatever. But that comfort emotion of being under 2%, it isn't there anymore. and certainly in the last month.
I think I've got one question, and I think a lot of people would share it. If you were speaking to your advisor this morning and you wanted to put some cash to work, take it out of the bank, and put it where you can actually get some real returns and put some pressure on these lenders to lift their interest rates. Do I take on a 6-month T-bill at 5, a 2-year at 4.90, a 10-year at 4%? That's the question, the kind of questions we've got to be asking of our guests. What should people be doing?
Stephen Major over at HSBC said that it's exactly the question.
What's he say?
Well, that's exactly the question in the bond market right now is, do you lock in a 4% yield longer term, or do you go for a 5% 6-month and believe that you can invest it in something equally attractive in 6 months from now?
It's the reinvestment risk around that view. That's the theme we'll keep trying to build on for the next couple of weeks. I don't know, maybe the next couple of years. Who knows? Based on the shape of this curve right now. Equity futures negative 0.4. This is Bloomberg.
You've been an advisor to the President of the United States on infrastructure and manufacturing, but on infrastructure, you've been involved with the legislation that was passed not long ago. Why is the United States infrastructure so terrible compared to so many other wealthy countries?
I have been around U.S. politics like you for a couple of decades and have served a variety of presidents from the different parties. And the attitude in the United States is obviously to keep taxes low and keep the public spend under control. And the word control is interesting, but that stops forward thinking in terms of planning. And therefore, the short-termism around our fiscal policies has hurt us. I mean, in essence, infrastructure is a long-term return. And to get a long-term return, putting it into private hands is one way of doing it. But really, the public side of life has to be willing to do the forward spend. The forward spend on airports and roads and EV charging stations has to come from the public domain. Now, raising taxes to spend money on infrastructure means you've got to trust the people doing the spending. And I think the public-private model is the way to go there, which is actually create an infrastructure bank that is U.S. public sector owned that has private sector matching funds. I think that sort of breakthrough has yet to occur in the United States. So where we go is tax and spend, which unfortunately one side of the aisle disagrees with.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
You have have to be disciplined. You have to respect market price action.
We started this year looking at a market that was driven by better than expected economic data.
We are cautious of the view that the market is perhaps pricing in a little too much for the Fed.
Ultimately, we're going to be getting back to nominal rates of 1.5%, 2%, but in the meantime, you may go significantly higher.
We still have more price increases to go, but there is an end in sight to this process. This is not the spiraling inflation that we saw in the 70s.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio and television. An absolutely historic day in economics, finance, and investment. John, at 4%, a 10-year yield, at 4%, a 30-year yield, our worlds have changed.
For a brief moment in time, the whole curve north of 4%, and the 2-year, Tom, getting closer to 5 at 490. This really builds on what we saw yesterday. Yields higher, equities down, off the back of what looks like sticky inflation, the prices paid component of the ISM data. That looks sticky. And then added into that, you got Eurozone core CPI. All-time high.
And it is about inflation, and we welcome all of you here. And I can't emphasize enough, as we heard from Porritt Garvey in that brilliant interview earlier, we've never seen this on the Bloomberg screen. And to me, John, the singular point here is the standard deviation move, the oscillation, the 30-year bond from the quiescence, it seems weeks ago, months ago, to where we are now is over 7 standard deviations. That's a medical chart.
In a single month, the 2-year has gone from 4.03% intraday low to 490. That has happened really quickly. You mentioned Porritt Garvey of ING. What's interesting about what he said, and we talked about it briefly, for him, it's not just about where we're going to end up. It's where we're not going back to. He does not think we're going back to sub 3% on Fed funds. His range, the way he thinks about it, 3 to 5, just 3 to 5.
And to measure this, and Carl Weinberg was brilliant up top saying, you know, we can get back to something as Mr. Garvey talked about. Lisa, the center tendency back 30 years in the 30-year bond now is about 2.3%. So is that maybe where we get back to, is above 2, but not that much above 2?
If you believe Porritt Garvey, maybe not, right? Maybe this is a new regime. And you asked, Tom, what gets us there? What is going to be different about this time?
Disinflation?
Right. Is it sort of the reversal of disinflation? Is it the sort of deglobalization or reshoring or pick your narrative? There is this question of what is the new paradigm and can it subsist for 3 decades as the market seems to be pricing out?
What's so important in this, and to both of you, John, let me start with you on goods and services. David Rosenberg, Ed Hyman, and others say we will see that disinflation. Can Lagarde and Powell hope and pray for that?
Well,
That's
they
the
embraced
mystery.
it for a heartbeat, didn't they? And now they started to look a little bit silly pretty quickly. I think they've got to be more open-minded about the two-way risk here. I know that people feel really passionate about going in one direction. Other people really feel really passionate about going in the other direction. Ultimately, if you're a policymaker, you can't feel passionate about anything. You've just got to balance the risks in front of you. And with that all in mind, they're going to go again, 25 basis points, and maybe again and again after that. You want to know the average of the 2-year? Since March 2009, the average 2-year yield since March 2009, 1.05%. That's the average. We're at 490 right now. If you want the low was only back in 2021, and we were at 10 basis points.
Let's get away from suits and bow ties. Lisa, what is a 7.1 if we break out to the new bank rate high, a 7.3% 30-year mortgage? We're not there yet, but if we get there, what's it mean for our viewers and listeners?
I'll tell you what it already means. Mortgage applications are at the lowest level in 28 years. You can see that people aren't refinancing. People aren't taking out new mortgages. They're buying in cash if they can. And so at what point does this really cause prices to come down? And then, oh, hey, wait a second. If the mortgage rates come down just a little bit, all of a sudden people rush back into the market and buy again. I mean, this is the whole question, the quagmire of disinflation, because the second that you get a little bit of softening in rates, it just bounces back.
John, bring us over to Europe with much higher inflation than here. This conversation in Europe has to border on bizarre.
Well, let's be clear here. There's a different pass-through to the mortgage market in the United Kingdom. The fixed-rate mortgages are much shorter in nature. There's a much bigger proportion of variable-rate mortgages there as well, so they feel it all up front. When Lisa was framing the mortgage market here in the United States, we were talking almost exclusively about the demand side. You and I have talked about the supply side. There aren't people willing to sell when they have a mortgage 30-year fixed at 3%. And I wonder how the supply side's going to develop, Tom, in the coming quarters.
Data, we're going to do it quickly here. Citigroup just publishes, they reaffirm 5% on China. They like the consumption model in China. John, that gets me to Brent crude, $85 a barrel.
What's amazing about this conversation over sticky inflation is that Brent crude, WTI, take your pick, year to date, it's flat, has not participated in the hoorah around the inflation story. There's your yield on a 10-year, just north of 4%, up 4 basis points on the session. You can call it 4.03%. Equity futures a bit softer in the face of all of that, and euro weaker, euro dollar just about holding on to 106 after we saw some core inflation in the eurozone, Tom, at a record high.
A perfect timing to talk to somebody really quite good at writing accessible notes of this turmoil. Liz Young is head of investment strategy at SoFi, and far more importantly, can frame the emotion. Liz Young, you say this is a louder and louder debate. What do I do with equities? What do I do with a boring retail account amid the louder and louder debate?
Yeah, good morning, everybody. So one of the things that I think has been most challenging for investors and professionals, both retail, institutional, you name it, is that we're sort of stuck in this range, and the market continues to kind of grind sideways between all these levels of resistance, support. What are the new levels? Everybody now knows what technicals are, and we continue to talk about them. But the reality is that we could be stuck here for a little while until we have a real catalyst to move us either up or down. My bet is still down, but then the question of what do you do in the meantime? I mean, we can't really tell people just to sit in cash for the next 12 months until we figure out what's going to happen. However, cash is an okay asset class to use in a portfolio. I would be still looking at the short end of the yield curve. Other places in equities that I think are interesting to look at, even though I do think that we will have a little bit more of a drawdown before we find real durable upside, but I would look at things that aren't as affected by some of these growth scares. So we've already seen technology get hit, consumer discretionary, communications, and rarely are the sectors that get you to the peak in the market the same ones that take you out of the trough. So you have to kind of change your mindset. Look at things like financials, materials, especially if we're going to be in a higher inflation for longer environment. And healthcare is always a good long-term play because the innovation just continues to impress me over time.
Liz, can we just talk about the bond market a little bit more? If a lot of people maybe haven't looked at this for like 10 years and now they're shifting away from equities and going back to bonds, and they're hearing you can get 5% on a 6-month, you can get 4.90 on a 2-year, 4% at a 10-year, and they call you up, Liz, and they just say, what do I do? Do I take the 6-month and then think about it in 6 months again? What do you suggest they should do?
I do think that's actually a good idea. So first of all, people haven't thought about the bond market, and rightfully so. It wasn't really offering any opportunity. There was no yield, there was no price appreciation opportunity, and then last year happened and all the opportunity came back. So when you look at usually bonds versus stocks, you're looking at what's the yield I can get on both. The dividend yield on the S&P 500 broadly is under 2%. If you can get almost 5% on a 6-month T-bill, why wouldn't you invest in that, right? So if you're looking for yield, if you're a yield-hungry investor, treasury bonds particularly are the right option here. Now, talking about just the term and how long you're going to put the money away for that, you could benefit from some price appreciation. So the longer you go out on the curve, the more sensitive the price of the bond is. But if you're just looking for yield and you want to park the cash in the meantime while we figure out what might happen with the equity market, I think 6 months, even shorter, is better. So you can look at money market funds, you can look at 6-month T-bills, but it is important to think about what the opportunity set is. And you want to have that optionality because, again, if we end up grinding sideways in the equity market, at a point where, let's say there is a drawdown, you want to be able to have dry powder to deploy into those opportunities.
Have the big tech stocks that really drove a lot of the index gains over the past few years, have they really realized what the world looks like in terms of their valuations, given a 5% Fed funds rate?
So if you look at, just take the NASDAQ or even the Qs, tech stocks are still technically in a bear market, so they have priced in a decent amount of this scare and a decent amount of the monetary tightening. However, I think that there continues to be a lot of appetite, and obviously we saw a very strong rally starting in January in those growthy areas of the market. So if there is more market stress, tech, communications, and consumer discretionary likely give some back still. What you want to look at, and the question of whether or not the stocks have priced it in yet, is inflation expectations. So we talk so much about the Fed funds rate and where the 6-month yield is and the 2-year yield is. Inflation expectations have gone up dramatically over the last 30 to 45 days. And that's something that the Fed watches very closely because they want those expectations to stay anchored. If they feel like those expectations are going up and they're losing control of them, you have to start pricing an even tighter Fed or an even longer, higher rate. So you have to think about that when you're looking at the valuations of tech stocks. I don't think that the market at large, tech stocks in particular, communications and discretionary, I don't think that they've priced in that higher inflation expectations level yet.
Hey, Liz, this was a clinic. Typically is. Thank you. Liz Young there of SoFi on equities on this bond market as well. Just to pick up on the break-evens point. Lisa, it's interesting to see what's happened with break-evens. I go back to what I said earlier. Without a corresponding rally in the commodity market, because typically we'd often have a conversation about break-evens picking up, and people would say, yeah, but this stuff's a little bit funky. It trades off what's happening in the commodity market. You've got a rally in crude. This is the pass-through, et cetera, et cetera. This is happening with crude flat year to date.
This is an excellent point that you're making. This is about services. This is about stickier other gauges that are outside of the more volatile commodity sectors. And that is why it is notable that you see the 2-year break-even rate, basically the expectations that are baked into markets for inflation over the next 2 years, go from a low in September of 1.98% to 3.3%. If you take a look at how big that increase has been, even with the tighter policy that's already been implemented.
Do you remember Carl Riccadonna? Do you remember Carl?
Of course I remember Carl.
You're not familiar with Carl?
We love Carl.
Carl used to work here. Do you remember Carl?
I don't, no? I don't.
Carl, don't hang up, please.
Carl Riccadonna's going to join us next from BNP Paribas. Looking forward to that conversation. Jobless claims in America. Big data point, important one, coming up in about 18 minutes.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Inflation in the euro area fell less than expected last month, and underlying price pressures rose to a record. That reinforces expectations that the European Central Bank will have to raise interest rates again. Consumer prices hit 8.5%. Core inflation, which is what policymakers are focusing on, rose 0.3 of a point to 5.6%. The G20 foreign ministers meeting in India has failed to agree on language to describe Russia's war in Ukraine. Instead of a formal joint statement, the diplomats will release what's being called an outcome statement. The same thing happened last weekend at a meeting of finance ministers. Both Russia and China objected to the use of the word war. The Biden administration is on a potential collision course with big tech companies. It's coming out today with an aggressive new cybersecurity strategy. The plan seeks to shift the blame from companies that get hacked to software manufacturers and device makers. The process will require Congress to pass legislation. Shares of Macy's are surging today. The department store operator reported better than expected fourth quarter earnings and comparable sales. Plus, the midpoint of Macy's full-year forecast beat the consensus. And Best Buy is predicting that sales will fall for a second straight year. The consumer electronics chain came out with a forecast that missed estimates. High inflation forcing shoppers to think twice before buying television, computers, and appliances. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. Coverage begins next week on Bloomberg. The top names at the Fed are on Bloomberg.
Inflation's normalizing, but it's coming down slowly. I just think there's going to be a lot more inertia, a lot more persistence to inflation than maybe we'd all want. I'm hearing people still out there pushing price and trying to test where the levels of inelasticity really are. As the meetings go on this year, we'll see what happens. If inflation settles, maybe we don't go quite as far. But if inflation persists, maybe we'll have to do more.
Nobody covers the Fed like Bloomberg, your global business authority.
March can be both seasonally positive or negative, but what we're seeing is this pattern over the last year where, we're in an earnings downtrend. And there's a presumption now, I think, by the market that because the economic data has been a little bit better than expected, including what we were expecting, that the earnings declines are now over. And that's not what we think. Some people think the worst is behind us. We think the worst is still probably ahead for most companies.
Brilliant to catch up with Mike Wilson, as always, of Morgan Stanley, the chief equity strategist on this equity market. He believes there could be still 20% downside on the S&P. We're lower today, not by that much. Thank goodness for many of you, I'm sure. We're down about 0.4% on the S&P. In the face of this in the bond market, your 10-year, north of 4%, 4.04% on a US 10-year, through 4.90 on a 2-year, and briefly this morning, through 4% on a 30-year. For a moment in time, in the last 30 minutes, the whole curve, 2s out to 30s, Tom, north of 4%.
If I'm a bull, I'm not saying I'm a bull or a bear, nobody cares what I am, but if I am a bull, I am rereading Michael Wilson this morning. It's just that simple. This is an absolutely original screen on a standard deviation basis, as you mentioned, the percent change that Mr. Wilson's looking at, and down 20%. And on that, and it's not that I'm gloomy, but I'm sobered this morning about where we are.
We had 2 years in 2 months. To be clear,
like that. Yeah, that's good.
January was a completely different story. Disinflationary process, all that good stuff. Yields down a bit, equities off to the races, tech rallies and leads. February starts, blowout payrolls report. Your 2 years near 4%. Right now it's near 5%. In a month. That's almost a 100 basis point move in a single month, Tom.
Yeah, well, the movements are there, which means, I guess, after talking to Porrick Garvey, we can talk to somebody that's expert in movements. The advantage of Carl Riccadonna, he's chief U.S. economist at BNP Paribas, joining us this morning, and of course with his decades of work at Bloomberg, is he understands Delta T. With the aerospace engineering at a small school in New Jersey a number of years ago, you are huge, frankly, like Kashkari, I should point out, has somewhat the same curricula here. None of us have seen these movements over Delta T. How does it change your economics?
Well, it certainly has been an exceptional period over the last 3 years, last 3 months, 3 weeks, pick your time frame. But what we're seeing here increasingly is that the policy prescription that looked like it was just about right now seems like we need to see a bigger dose of restriction.
That's the Goldilocks
from the Federal
analysis.
It's not exactly Goldilocks, given the persistence we're seeing in the inflation numbers, let alone the persistence we're seeing or the resilience we're seeing in the economy and labor market. It's now apparent that it has to be something north of 5%, and depending how much the economy reaccelerates, we could be looking at a risk scenario that is even towards a 6% terminal Fed funds rate.
You said
there's
depending
a
how
lot
much
of momentum here.
It reaccelerates.
Right.
Assuming it reaccelerates, is that your base case now?
I think we've seen some signs of reacceleration. The narrative for really from the middle of 2021 right through the end of last year was one of deceleration. And I think that's a big reason why the Fed was willing to say, collectively, we have pretty much the right prescription in place. We just need to wait it out, wait for the long and variable lags, which may be a little shorter than they have been historically, but to wait for those to kind of percolate through the system. And in doing so, they slightly took their eye off the ball with respect to financial conditions. We saw this easing of financial conditions, which, using the Bloomberg Index, it leads the real economy by about 2 quarters. that easing started in September. In January, we start to see the strong data, right? There's a, 1 month doesn't make a trend, but it starts to look a little bit like that, risk scenario could start to play out. That being said, January can be a very strange month in terms of seasonal factors, weather distortions, et cetera. So I think we really have to wait to see a little bit more signs from the February economic data, not hysterically react to just 1 month.
So there's 3 stops. Next stop is Chairman Powell, semi-annual testimony. After that, March 10th, we get the payrolls report. I believe March 14th, the CPI report. Walk me through those 3 phases. What do you expect to hear from Chairman Powell? And are you expecting the February data to confirm some of what we saw in January?
Can we take one more stop along the way?
Please do.
I think the services ISM coming up at the end of the week here is going to be a very critical report. That was a big factor, right? There were huge question marks around the January payroll print and what the real number should have been, considering the back revisions, the benchmark revisions, the extension of the work week. It looked less like a 500,000 print and more like a 1.5 million print. But we know some of that is distortion and will wash out in February. So I sure hope February doesn't look like what we saw in January, because then we have to really tear up the playbook and think of a very different outcome. I think that we will hear from the chair, which we've seen from a lot of Fed speakers, a lean in to a more hawkish narrative. Some of them are teasing the idea that 50s could still be on the table. The Fed really doesn't want to do that after they've downshifted and then upshifted. It's a credibility issue. But you'll hear a hawkish lean in from Chair Powell when he testifies, and really the kind of a reprise of what we heard in Jackson Hole last year. So this conviction, this resolute, Volcker-esque, keep at it, do whatever it takes kind of thing. And we'll have plenty of time for him to get that message across.
Although usually the shorter he goes, the more clear his message is. I am curious, as you look towards some of the employment data, the anecdotal evidence seems to suggest it still is a very tight labor market. What would you have to see, whether it comes to the payrolls report next up, whether it comes to JOLTS, which we get, I believe, next week? What do you have to see, or initial jobless claims up, to game out a 6% Fed funds rate?
Well, I think we have to see compelling evidence of the reacceleration, and we haven't seen that yet. We've seen hints that kind of raise the eyebrow and get you to start thinking about that, but we haven't seen the compelling evidence. So I'm looking for about 240,000 on non-farm payrolls, and I still think the long lags, right? Let's say you believe in the long and variable lags of Milton Friedman's era and say 12 to 18 months. Where were Fed funds 12 to 18 months ago? 0, right? Even if you think it shortened to 12 months, that's still 0, right? So there's a lot of tightening that hasn't yet percolated through the system. I think if we're looking at new lows in the unemployment rate and a reacceleration in average hourly earnings, I think those will be the compelling factors that would lead the Fed to think the prescription we have in place is not aggressive enough. And I think there's some compelling reasons to think there might be some upside risk to average hourly earnings next week.
Interesting. Carl, you're going to stick with us. We've got jobless claims in about 7 minutes or so. I'm so pleased that Carl said that. Tom, 12 months ago, they were still doing QE and rates were at 0. We've kind of forgotten that because we got wrapped up in these 75 basis point moves. But a year ago, they were still doing QE and rates were at 0.
Yes, a year ago, this is really important, the distinction between a year ago and 18 months ago. Where were we within pandemic mathematics? And I do think there's a case that they ignored better trends in cases, hospitalizations, and deaths where we healed, but they couldn't be sure of that, could they?
I question these long and variable lags. Don't you see them somewhere?
I'm not a fan.
But my question is, don't you start to see? No, but there are a lot of people who believe in this, and then it'll trickle through to the economy. But where is it going to trickle through? I mean, is it just the tighter lending standards?
Mortgage
some of the
rates.
Banks? Mortgage rates.
Auto loan rates.
But mortgage rates, people are going to basically say, okay, I have a 3.5% mortgage. You can buy my home. I'll transfer it over. Just change the title, and then I can use this. I mean, like all sorts of shenanigans are going to happen. I mean, this is it because it's locked in for 30 years.
Well, precisely. So in that case, Carla, they just super long. Is that?
Do you want to be locked into your house for 30 years?
Well, maybe.
At 3%.
No, yeah, exactly.
Long and variable lags is an artifact from Newsweek magazine from 50 years ago, and we're not living Milton Friedman's economy
It is shorter.
It's
absolutely.
shorter.
The Fed
Thank
literature,
you.
the academic
rates,
research.
Excuse me, we're doing engineering here with Rick Adana. The SLU rates have changed.
Yes, the SLU rates have changed. It is shorter. I think there's a compelling case. The Fed is much more transparent than it was 50 years ago or even 30 or 40 years ago. So that arguably makes it a quicker transmission mechanism. There still is some lag.
Okay, fine. I mean, he's talking like
maybe it's not 12 to 18, it might be 6 to 12 now.
All the media's running around going long and variable lags because they were taught to say that. Baloney. It's from another time ago, is what I would suggest.
Long-ish and variable.
I want to go. I'm going.
It's in the
Paul
process
Romer
of being defined still. It's just a way of saying I don't know, I don't have a clue. They're just long and variable. Very variable, by the way.
I could go on all day on it. Shut up, Tom.
Well, the clock's running
Get
out.
to Cork. Where's the surveillance
Carl,
court?
stick with us. Claim's coming up in about 5 minutes' time. I'm going to run. I love you, Carl, anyway. In the next hour on Bloomberg TV, Richard Bernstein of Richard Bernstein Advisors. He thinks this is a new regime. Chris Harvey of Wells Fargo, he said recently this bear market is over. And we'll catch up with Sarah Hunt of Alpine Saxon Woods on energy around the opening bout. Looking forward to that. Lisa, the fate of this program is in your hands for the next 35 minutes.
Uh-oh. It's going to be long and variable lags between now.
Incredibly variable.
Incredibly variable.
Future's negative. This is Bloomberg.
We have only 8% of the ocean protected today. And our Earthshot is, as Patty said, 30 by 30. 30% of the ocean, at least, 30% of the ocean protected by 2030. And we know that if we protect the right 30%, not only we will prevent the extinction of many marine species, but also we will produce more fish. There's going to be, these protected areas are going to produce a spillover that will exceed the foregone catch. So we're going to have more fish to eat, food security, livelihoods for people. And we know that for every dollar that we invest in a protected area, in a marine reserve, that produces $10 in economic output and creates more jobs. So it's a triple win for marine life, for food security, and for climate, and of course, for the economy. So that's the goal, the mission.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg. Historic day, Bloomberg surveillance, Lisa Abramowitz and Tom Keene with yields out rounded up 30-year 4%, 10-year 4%, 4.91% on the 2-year yield, which leads us to the economics of the moment. I am riveted not by claims, I am riveted by unit labor costs, and Michael McKee will brief us here as best he can. We're waiting for the data, Mike. I mean, I guess there's a pause here, and get to 0-0.
It doesn't happen until 8:30 exactly here,
Mike.
but we do have the unit labor costs number coming in, and it is very strong. And we do have the claims number coming in, and I'll give that first since most people want to know about claims. We'll keep Tom in suspense. 190,000. Can you believe that? We continue to see jobless claims not rise because the economy is slowing, but fall because the economy is doing who knows what. We'll turn to Carl in a moment to ask about that. All right, Tom, here's your number.
After a long and variable lag, we'll do it.
Here's your number on the unit labor costs, 3.2%. And what's interesting is that's a revision to fourth quarter productivity. So we are doing quite well here. Compared to 1.1% the last time. 1.7% for non-farm productivity. That is down from the 3% while ago. So it does look like there is a strong possibility that maybe we are seeing companies pay up to get work done. But right now, the amazing thing is the jobless claims numbers that just continue to hang in there. I mean, we don't even get a slight movement up or down. They were 192,000, down 2,000 from last week. So
let me do a micro check, and I want to come back to you, Mike, before we go to Mr. Riccadonna with BNP Paribas. Yield surge. 4.06%. Lisa up 7 basis points. Now the 30-year bond well out over 4% is well. And at least I really want to emphasize this is a lift to the curve. Priya Misra to join us here in 10 or 15 minutes. This is a dynamic move in fixed income off this economic data.
What I find fascinating is where it's coming from. Yes, you're seeing it on the front end, but it's coming even more so at the long end or equally at the long end. And to me, this is a change from what we saw in previous times. This isn't just about Fed policy. This is about a shifted view of this labor market and how sustainable inflation is.
How does it shift the view, Mike, at the Fed? You are knee-deep in this with your important interviews with presidents and governors. They've got to be sobered by these large standard deviation moves.
Well, I think they have been. They've been as surprised as everybody else by the fact that the economy is stronger than anybody seems to have thought it was. Again, I go back to the fact that this is not your standard recovery from a standard recession, and a lot of the models aren't working the way you would think they would. But we've seen more and more of them come out and say higher for longer. Yesterday, we had Raphael Bostic raising his view of where rates should go, and Neil Kashkari laying 50 basis points as a possibility for the next meeting on the table. Kashkari being a voter, that's something to keep in mind there. So, yeah, the Fed is looking at this and thinking that they may have to do more. They're going to take it meeting by meeting and see what happens. But right now, they wouldn't argue, perhaps, with people who are raising their bets in the markets. Again, I go back to, though, something I've said before, that if you are betting on higher interest rates in U.S. Treasuries today, you're doing that based on information, for the most part, from a month ago. The claims numbers are new, but everything else, I mean, the productivity and unit labor cost numbers are for the fourth quarter.
Well,
you have some people who might start to question the data, say that in this era where people hang up when anyone calls to give them a survey, this isn't as accurate as it has been traditionally. Do you buy into that? Do you ascribe to the lack of accuracy of potentially this data based on modern technology and the way that some of these surveys have been collected?
I think they do good enough work at the Bureau of Labor Statistics that the jobs numbers are pretty good, and the Bureau of Labor Statistics is also doing a lot of work in changing the way it gets the data for the CPI numbers. They're going to private sector providers because sometimes they can't get the data on a timely basis in the way they used to. And the real question is perhaps in the unemployment numbers, because that is, in large measure, a telephone survey. But I have no reason to believe they're not doing their best to make it statistically accurate. We do know there are questions about unemployment claims because the systems are so old in many states. But I think this is the consistency with which we're seeing low claims is probably some sort of guarantee, not guarantee, but some sort of show that we are seeing things accurately.
At this historic moment, we're going to have Mike McKee stay with us, and joining Michael McKee is, of course, Carl Riccadonna with BNP Paribas, the chief U.S. economist. Again, out 8 beeps on the 10-year, 4.08%. The 30-year bond is a stunning 4.03%. I want to allude here to the complexities of productivity. I'm going to call it 3 ratios, lots of partial differentials there. And the bottom line is, people like you are hoping and praying that our post-pandemic productivity, that our post-pandemic efficiency is good. That data tells me maybe not. Fold productivity into this volatile market debate.
Well, the productivity numbers, if we look at them in year-on-year terms, are actually deep into negative territory, almost down 2%. So we have very strong job gains in an economy that is slowing. So that's not really sustainable, but it can kind of run that way, and the inconsistency can last for, at least multiple quarters. The cost number in year-on-year terms, and it's even more disturbing. It's 6.3%, as I see in the Bloomberg table here. So 6% plus on a unit labor cost. If we look at the employment cost index running at 5%, these are the elements of wage price spiral. And I know Chair Powell has said he doesn't think we're in a wage price spiral at the moment, but once you're there, it's too late, and it's a very expensive problem
Let me
to
give
fix.
you a historical
so
here, Tom.
this factors into how the Fed is thinking about that.
Annual average productivity decreased 1.7% from 2021 to 2022, the BLS says, the largest annual decline in the measure since 1974.
Wow.
That's it. And that precisely gets back to 4 to 5 years before Volcker and shows the scope and scale of this historic moment. I just want to point out, Lisa, Riccadonna can come back because he uses the Bloomberg terminal. It's good how that works.
Well, but Carl, aside from your usage of the Bloomberg terminal, I am curious, as you parse through this, we were just talking before these numbers came out that you were looking for more evidence that there was something stickier in nature about these numbers that we got out in January. Is this leaning you a little bit closer to that moment?
We are seeing persistent inflation everywhere. That's been a longstanding call of my team at BNP. We're seeing persistent inflation everywhere, including in wages. And there was a little bit of a rollover in Q4. And so Team Transitory was putting on their sneakers to run a victory lap. And it's pretty clear that has kind of washed out now in the most recent data. So we have to see how far this is running. But certainly, I see evidence of labor market softening everywhere I look, except for in the economic data. Right? If you open the newspaper, you see layoffs here and hiring intentions down and all those signals. But in the actual macroeconomic data, you're not seeing the cooling of conditions.
And we have seen this. There was a Wall Street Journal article about this as well. I am looking right now at 10-year yields, getting close to that 4.1%, 4.08% rounded up to the nearest 10th. 100th. I'm curious from your perspective whether we're getting to a perspective where it is a new regime, where productivity is going to be lower, labor costs are going to be higher. You have a different kind of labor market and workforce that's going to require more investment. Are you seeing enough signs that we are there?
When you have that kind of heat in the labor cost pressure series on an extended basis, businesses have no alternative aside from making the capital investments and the technological investments to drive a productivity rebound. Just real quick, the broader story here, we surged in productivity coming out of the pandemic, right? So now this is the correction period. So we shouldn't get too depressed about the low productivity numbers.
Also, the BLS notes that they applied the historical revisions that they put into the jobs report and into the CPI reports to this release, which is probably why it is such a huge jump.
To the two of you here, and you got a minute and a half to warble gaily, as Lisa mentioned earlier today, blah, blah, blah. And the answer here is, does this shift the 50 beeps at next meeting debate? Michael?
Oh, I would say no, this doesn't. I mean, we have too much data coming out ahead of us that's far more important than this. Jobs and CPI will have a much bigger influence on the Fed than
Carl,
today's
you
number.
believe
I will warble gaily and in uniform harmony with Mike.
You're not supposed to agree with me.
For bad TV.
Yeah,
The jobs
please, come
report,
on.
the inflation report, that's going to be much more critical. This is kind of stuff we already knew from
So
the
what's the
jobs
inflation report look like?
The inflation report, if we look into the details...
You look at Germany, you look at France, you look at Spain.
Right, look at the
trend.
U.S. service sector inflation, which is what is really driving the Fed reaction function, is showing very little evidence of any kind of disinflationary trend. And you won't see that with wage pressures continuing to accelerate higher.
And tomorrow we do get at 10 a.m. the ISM Services Index, and that is going to be key. Not just the index, but prices paid for that. Given the fact that we saw manufacturing prices paid increase to the degree that they did, if you see that kind of move in services, could that really move the dial?
Yeah, the prices matter, but it's an activity gauge, so the new orders, the production numbers, that really will tell us more about this potential reacceleration.
One thing about the European numbers, too, is they were largely driven by food prices, which has not been a big issue here. I mean, we've had elevated food prices, but we've seen them come down.
What are we being driven by then?
Service prices, much more
Flying
so than
around.
what's been happening
Getting
in Europe.
Yeah, but flying is
Well, you were talking yesterday about
with or without shelter.
I got the three of you piling on me together. Mike, please.
You were talking yesterday about the differences between the way the U.S. and Europe dealt with unemployment during the pandemic. Europe kept workers on the job by subsidizing employers, and so the employers didn't have to go out and raise wages as much as they've had to do in the U.S.
Well, let's continue this discussion. We're going to do a data check now. Lisa, help me here, because I don't see much spread movement. I do see a 10-year real yield come out to a 1.59%, but in the actual yield space, NASDAQ down a 1% here on the NASDAQ 100, but Lisa, 4.07% on the 10-year yield is just stunning.
The nominal yield is really what I'm looking at, and not just that, but the 30-year. It crossed 4% for the first time and went straight to 4.02%, and we're looking at just this real trajectory of higher inflation for longer being gamed out in some of the yield structure, and that, I think, is a game changer.
On radio and television, thank you for continuing with us. Priya Misra will join us here in a moment. We thank Carl Riccadina of BNP Paribas and always Michael McKee for driving this stunning debate forward. I can't emphasize enough the historic nature of the day. Away from this, dollar strength and renewed strength off of this report. DXY 105. John Farrell emails and it says, stupid, quote the euro, 105.95. Weaker euro off the report. Stay with us. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. SpaceX launched a 4-person crew to the International Space Station early today. It includes 2 Americans, a Russian, and an astronaut from the United Arab Emirates. They'll arrive at the space station on Friday and stay there for 6 months. It's the first victory for Republicans in their crusade against so-called woke capitalism. The Democratic-led Senate voted to block a Labor Department rule that allows retirement plans to consider environmental, social, and governance issues in their investment decisions. President Biden's expected to veto that measure. Billionaire Oleg Deripaska wants that Russia may run out of money next year. And Deripaska's comments are among the most outspoken by a prominent Russian business leader. He says Moscow needs investment from friendly countries to break the hold of the sanctions on the economy. China has pledged to invest an additional $1.9 billion in the country's biggest maker of memory chips. The money is going to Yangtze Memory Technologies. It's a deal that may signal a renewed influx of government support into an industry hit by U.S. sanctions. It's a double blow to the UK's capital market. Europe's largest building materials company and a jewel of Britain's technology industry have picked New York for their main listings. CRH plans to move its primary listing from London, and homegrown tech giant ARM has decided against selling shares on the London Stock Exchange for now. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because this is really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this, put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
The way the Fed is pursuing policy here is kind of smart. I know the Fed gets a hard rap because of missing the early rate hikes, but 25s from here is quite smart. They got to keep on 25s and level off. And at a certain point in time, this degree of tightening has got to hurt.
If you are part of Global Wall Street, it is my requirement for the day. You must listen to our entire Park Garvey interview with ING Financial Markets. Find it out on all the social that we do. I really can't say enough about the sophistication of the gentleman from Dublin with ING again over where we are. And certainly his modeling of a new regime of inflation speaks true to the short-term data. Lisa Abramowitz, the 10-year up 7 beeps. The 30-year bond up 7 beats. We're seeing huge moves in the bond market.
6 months ago, when people saw these kinds of levels, they said buy. And that's why in November we saw these levels, and then we saw yields come down. This is the key question for today. Are we watching actually fair value for a longer period of time?
To put things into perspective, I'm going to do that right now. Priya Misra and Lisa Abramowitz are far, far too young to remember when Bob Redford stood outside the Plaza Hotel in The Way We Were, and with Barbara Streisand, they said memories, da-da-da-da-da-da-da. Guess what? Productivity dynamics are back to 1974. Someone who has been expert at measuring this over to our financial bond market is Priya Misra of TD Securities, and she joins us this morning. We're looking at the history of this, Priya, and we're also looking at your brilliant call on inversion. Although some have been brave recently and said, look, higher yields, I get a coupon along the way. I want to be brave here in February and March of 2023. Did the bravery, the courage, did it slip away this morning?
Thanks for having me on. So, no, I think you have to be patient. It's hard to pick the absolute top in yield. You know, you're talking about having confidence. I don't have a ton of confidence in the front end because, you know, we know inflation is sticky. We know it's driven, core services ex shelter is driven by wages. It's a very tight labor market and companies are hoarding labor. So it's possible that inflation remains persistently high through the year, and the Fed, we think in 25 basis point increments, may have to keep hiking, maybe 5.75, maybe 6%. So, you know, that very front end of the yield curve, I think, is very driven by data in the near term. The long end, that's your view, that's your neutral rate view. And I think the data is strong on the consumer, on the labor market, not because policy is not restrictive. We are in restrictive territory. It's because the lags have not worked through. I mean, the Fed fund rate crossed 4% only in December. You have to give the economy more than 2 months for it to keel over. And I think, you know, that's why the long end is selling off. People expect that interest rates don't matter. I think interest rates matter. They just take a while to show up in terms of business investment decisions or spending decisions.
Priya, I want to go to the it takes a while. If I've got a 7 standard deviation move from very low 30-year yields out to very high 30-year yields, stunningly out above the great moderation, And I go back to whatever the new center tendency is, how long does that take? Is this a matter of 6 months, or is it a matter of 6 years to get back to normal?
Sure. So economic theory suggests 12 to 18 months for monetary policy to work through. I mean, you could argue maybe it's a little bit shorter. Maybe it's 12 months, 9 months. I will say something that may be making the lags longer this time is that the consumer entered the hiking cycle with a large amount of accumulated savings. Now, those savings are running off. We're tracking, by the end of this year, we're thinking in the third quarter, those savings are largely gone. That's when the consumer has to start to reckon with higher interest rates, tighter financial conditions, maybe a job market that's not as strong. I mean, there may not be a lot of firing, but job openings start to come off. So I think it's more later this year that we think consumer spending slows down, the job market starts to weaken. So I don't think you're waiting 6 years, but we are watching those savings numbers, and the savings continue to come off. But, today if I have a job and I'm making 5% wage growth, wage gains, and I've got savings, I'm spending. I think we're just saying be careful in extrapolating that because those savings will run out by the end of the year.
How much conviction do you have, Priya, to load the boat on 10-year, to load the boat on 30-year treasuries?
So I have much more conviction on the 10-year and the 30-year than I do on the front end. I don't know about loading the boat. I used the word I used, I guess, a few weeks ago when I started to leg in. I would leg in some more because, I think we entered some around 380. We'll enter some more longs at 4%. I think the Fed's telling you that they have to engineer a hard landing. They're not going to say it because it's very hard politically to get that through, but how do you get inflation down without a rise in the unemployment rate? So the Fed will have to engineer a rise in the unemployment rate. Then these 4% 10s will look really cheap, but is 4 the peak or 4.10? No, maybe it goes to 4.25. So I think you want to have some dry powder to keep adding to it. But I think, these levels in a long-term sense, I don't think R star is higher or the neutral rate should be much higher. I think the Fed is committed to 2% inflation, and we've seen productivity. I don't think the economy can handle very high real rates in the long run.
Priya, this is such an important point, and it goes against what Porrick Garvey was saying, where he said, listen, people think we're going back to the same kind of regime we were in prior. You're saying we are going to go back to that regime. What gives you confidence other than just that the Fed is committed to a 2% inflation regime, especially if a 2% inflation regime is different from the prior 10 years, which it wasn't a 2% inflation regime, as Tom mentioned. It was a sub 2% inflation rate.
Right. So I think there are some structural factors that might be moving inflation a little higher. So if we were sub 2%, maybe the next 10 years will be a 2% number. But I think inflation does, if the Fed thinks they want to get to 2, they're going to keep policy restrictive for a while. They're going to keep that front end, not cut rates anytime soon. Real R star or real equilibrium rate, I mean, those are driven by productivity, demographics, savings glut. I don't know if any of this has changed, after COVID. So maybe it's not 0, it's 50 basis points, but we're well north of that in terms of market pricing of real rates.
Priya, with respect to the giant Stanley Fischer, who I would suggest codified ultra-accommodative as his work as the vice chairman, and Ben Emmons at Newlands just writes this up. I've never used this phrase before, Priya, and Ben doesn't predict this, but he suggests, does this data drive us out to ultra-restrictive? Is the larger pendulum here from ultra-accommodative out to ultra-restrictive?
No, I think it's fair. I mean, the move in real rates, it's not just the front-end real rates. Look at where 10-year real rates are. And the speed of the move over the last year, the extent of tightening, I think can move us from ultra-accommodative to ultra-restrictive. But we're not seeing it in the data yet. And so I think this is where we need to be patient. I don't know if the Fed can be patient. Are they going to feel the pressure to go faster, go higher? We actually think they're going to be patient and go at 25, try and feel their way around that end point, and then keep it there for a while until inflation comes down. But yeah, we are in restrictive territory. I think there's no question. We just got there pretty late last year, though.
Very good. Priya Mesra, thank you so much for joining us from the fixed income fallout shelter. She is with TD Securities. Just wonderful to have her there. And truly, folks, one of the great calls of the last 18 months on curve aversion. Right now, Lisa, negative 86 points on the vanilla.
Yeah, and what we're seeing right now is a really interesting, and what she was talking about, that we're going to get back down to a level that looks like something we're familiar with. And the reason why she's legging in to 10-year treasuries, even as they rise. Here's the question: how high do real yields have to be to keep inflation around that 2% goal? And I say that because if you look at the 10-year real yield, that is the inflation-adjusted yield in the U.S. for the next 10 years, it is closing in on some of the highest levels that we've seen going back to 2009. It is grinding higher.
Grinding higher. It's been a non-story, and you're right. It deserves study.
Because this changes the risk value, the risk-reward valuation for stocks, for risk assets. And at what point does that start to shift things a little bit?
Inside baseball, folks, to show you what we do here, we compare the percentage move of DXY with the percentage move of the Bloomberg Dollar Index, which is more EM tinged. And with the stronger dollar here, Lisa, I'm seeing some of these EM currencies, including Chinese yuan, 0.92. Argentinian peso is going to enjoy a 198 here in a cup of coffee. And even Turkish lira, with all that's going on there, the horrific earthquake, goes out to new weakness right now. This is a global story that we're seeing on this historic day.
Although it's hard to extrapolate too much from these data points, because it seems like this market is a bit histrionic, and we'll go toward one narrative very quickly and then shift gears and go the opposite direction.
NASDAQ negative 1%. You want to stay on television. Mr. Farrell will have Mr. Bernstein of Value and Growth. Really looking forward to that as well. We'll drive forward this dialogue. Stay with Bloomberg through this historic day. This is Bloomberg Surveillance.
Why 1953 specifically?
1953 has a lot of relevance in general. So that's the year where the European countries start opening up their imports to the dollar zone. It's the London debt deal with the Germans after the war around German debt. But it's also one of the years where the Fed is really forced to make a really important decision. So it's where a lot of their desire to get out of the bond market, and I'm sure we'll talk about what they did during the Second World War, it's a very controlled market. It's very heavily managed by the Fed on an active basis. They really pegged yields in the long end, and getting out of that is complicated. And in 53 is when the market really tests them. So we didn't have the "don't fight the Fed" mantra quite yet at that point.
But this is like a really interesting philosophical question right here, because there's always this question today or in any period: to what degree is the rate that we see on a 10-year, on a 30-year, on a 2-year, a policy rate versus a market rate? Before we get to 53 specifically, can you just talk a little bit more about what you said about how rates across the curve were essentially policy rates?
Yeah, when we think about a 10-year rate, like you could do one of two things. You can roll treasury bills every 3 months for 10 years, or you can buy a 10-year bond. So in a perfect world, those two things are connected through expectations.
So let's go inside the boardroom. Let's suppose you win a proxy fight and/or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside of that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. and we present them with the plan.
This is Bloomberg.
The whole yield curve, 2s out to 30s, a four handle right across the curve. Live from New York City this morning. Good morning, good morning. Equities down 0.6%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York coming up, global rates shifting higher as inflation looks sticky. An ESG showdown between the White House and the Senate, and Chevron getting behind the bullish view on oil. We begin with the big issue, higher for longer.
They have told you over and over again
the job is not done. What the Fed has been telling us all along.
They're going to be higher for longer.
Higher for longer is where we're going.
What does higher for longer truly mean?
The yield curve is too complacent in pricing this temporary high interest rate environment.
As we sort of look at the different segments of the yield curve,
we've seen the 2-year and the 3-year starting to lead the widening.
We're probably getting closer to the top on the long end of the curve.
We need to see the 3-year and 4-year part, so the belly and the front end pricing higher here.
But I don't think you fight the Fed here.
We're certainly all beholden to the data at this point.
What a move this morning. Equities down by about 0.6% on the S&P, 492, 493 on a 2-year, on a 10-year, a 4-handle. Joining us now to discuss, Chris Harvey of Wells Fargo, Richard Bernstein of RB Advisors. Richard, you said this was a new regime. Is this looking more like a new regime?
Oh, I think, Jonathan, it's been our story since the Fed started tightening, that inflation is just harder to fight than people think. And I understand how our industry wants to go back to a period of cheap and abundant liquidity, because that's what the financial sector really loves. But I think the odds of that happening anytime soon are slim and none, and Slim just walked out the door.
Chris Harvey, 4%. How does that change your world?
It doesn't really change my world all that much. We've been back up at 4% early in the fall. Higher rates are something we're going to have to deal with. What we like to see is we place a lot more focus, a lot more time on the credit markets. Credit markets are acting, behaving normally, and that's what we like. 125 basis points of spread for IGs is a pretty good level at this point. And really, I think Rich said it best. It's data dependent. That's what we're looking at. We're watching the data. Yeah, interest rates have moved up, but really it's more about the data, and the data's mixed. But more importantly, the economy still continues to be in this kind of economic malaise, not hard landing type situation.
Chris, something you mentioned in your research in the last couple of weeks, you said the bear market was over. Now, I have to say up front, you didn't say a rip-roaring bull market was about to begin, but you said the bear market was over. How does your equity market compete with a 5% 6-month T-bill, a 2-year at 4.90, a 10-year at 4%?
Yeah, it's very difficult to compete. At this point, you have if you look at the front end of the curve, and you tack on some sort of IG or high yield spread, that's a pretty competitive rate of return. And so we're not all bulled up at this point in time. The reason for the note saying the bear market was over is you really shouldn't trade this like a bear market. You shouldn't expect the wheels to fall off the cart. You shouldn't be afraid to trade this market. Don't expect things to just collapse. That's not true. The underlying fundamentals are good enough. The credit markets are strong enough. And if you find good risk rewards, that's where you want to place your emphasis. But this is not the great bull market, the beginning of the great bull market. What this is finding really good risk rewards. Some of that is on the front end of the rate curve. Some of that is in mid-cap growth, and some of that is overseas.
Richard, something has come up between you and I, a discussion about the amount of people that are still out there who believe the old world is coming back. The pre-pandemic world of low rates, low inflation, a Federal Reserve looking at 0 to 2, maybe is the range. We caught up with one individual, Porrick Garvey from ING earlier this morning. He said, we're not going back there. The new range for Fed funds is 3 to 5. Rich, is that your word as well?
I think so, at least for now, John. I think, throughout my entire career, people generally argued that the Fed wasn't even in tightening mode until the real Fed funds rate turned positive. Well, that's just starting to happen. And of course, you know, although certain parts of the economy, as Chris points out, are not doing well, the overall economy is doing fine. You know, I mean, 1Q GDP is tracking right now at about 2.5%, take or leave. That's hardly a recession type number. So the Fed is just getting to its tightening mode. And I think we've seen the strength in the economy that's been fighting the Fed all along. And now the Fed is finally in the point where it can start talking about tightening and slowing the economy. But I think the economy's responded exactly as history would have said that it would have when you have a real Fed funds rate that's negative.
Well, look at the data right now, 190 on claims. Claims came out 35 minutes ago, 190,000 on claims. Unit labor costs coming at 3.2%. Granted, unit labor costs was for the fourth quarter, but this labor market is looking super tight. We need to work out what the Fed's going to do at the next meeting. Minneapolis Fed President Neil Kashkari said to me, it's much more important what we signal with the so-called dot plot, not whether we go 25 or 50. Chris, when they sit down at this Fed meeting later this month, they're going to have one extra payrolls report, March 10th, an extra CPI report, March 14th. Do you need to see both those things before you can draw any conclusions on what you can expect from the Fed later this month?
I think the Fed has been very clear. They want to get to 5%, maybe a little bit more than 5%, then they want to wait, right? If that narrative changes, I think they take a hit to credibility. Some of the data has come in a bit stronger in recent weeks, but earlier this year, some of the data came in a bit weaker. And that's what you should expect, right? The data should be mixed. I don't think there's enough in the data there's a lot of talk about, oh, can they go 50? I don't think they need to. What they need to do is exactly what they're saying. Get to in and around 5%. Wait. You know, as any economist will tell you, there's long and variable lags to monetary policy and all these other issues. Inflation is slowly coming down, but grudgingly, right? And so now the question is, how long can you wait? We're in a good situation where the economy has not cracked, right? But you've taken speculation on the market. Inflation is slowly coming down. You're normalizing rates, and you're in a pretty good spot. So you really don't have to rock the boat. Just continue to do what along your narrative, what you're talking about, that 5% level, in and around that 5% level, and then wait. And again, the data, I think, will be mixed going forward. It's not going to be one-sided. And ultimately, we're going to get to a lower level of inflation. But 2%, I think, is much more aspirational than anything else.
Chris, to your point, it hasn't cracked. Now, Richard, a year ago, if I said 3, people might have expected a break. If I said 4, they'd be dead certain we'd get one. If I said 5, no chance. We're staring down the barrel of 5. We may even have a little look at 6. Richard, what can we live with?
So John, I think the question is exactly what Chris was talking about before, are these lags, and I don't think anybody knows. And I think right now there's a lot of economists who think the Fed should do something, but that's not the way to invest. It's not what they should do, it's what they will do. And I think we all have to understand that the credibility of central banking is on the line here. And so the Fed is going to consistently err, regardless whether you do 25 or 50, they are going to err on the side of being tighter as opposed to looser. The markets are making a big bet right now that the worst is over, and then we can all go speculate because there's going to be, you know, lots of cheap and abundant liquidity is going to return. I just don't think that's right. I don't think the Fed has the flexibility to do that.
Well, what was the Fed doing a month ago then, Rich? What was that all about? What was the disinflationary process that started? What was that talk about from Chairman Powell?
I'm not quite sure, to be honest with you, because the data was still pretty strong. As Chris points out, it wasn't ripping data, but it was still reasonably strong data. The inflation data, although slowing, was not comfortable. There were still many things that were saying that inflation wasn't over yet. I mean, John, the Atlanta Fed puts out a monthly chart that looks at 9 what they think are the most important inflation measures. Right now, 7 of the 9 are higher than they were a year ago. I can't imagine the Fed taking their foot off the brake when 7 of 9, what they consider to be important inflation measures, are higher than a year ago. That just doesn't make any sense to me.
Mohamed El-Erian was absolutely scathing in Bloomberg Opinion this morning. There was one paragraph, and I'll pick up on a bit of it for you, where he called it a multi-stage policy error in which the Fed first mischaracterized inflation as transitory for a protracted period, moved too slowly, he went on to say, in adjusting policy once it retired transitory from its vocab, and then fell behind the policy challenge for a third time. by downshifting its increases. And every week we get more data, and every week that data makes that subtle shift from Chairman Powell look a little bit more sillier. Looking at the market this morning, if you are just tuning in, we're down about 0.6% on the S&P. This market has to confront what's happening in bonds right now. 2s, 10s, 30s, right across the curve. We're north of 4%. We're approaching 5 on a 2-year, at 4 basis points at 492 on a 10-year, north of 4%. Yesterday, we had an ISM manufacturing survey come out. It wasn't about the headline number. That improved, but it was still sub 50. It was about the prices paid component of it. Anything that speaks to sticky inflation right now, that was what Alan Ruskin at Deutsche Bank had to say, just spooks this market, and this market was spooked. Now, Richard, I know you don't like US tech. We've talked about that a few times, but year to date, discretionary's done pretty well. You're not a big fan there either. Why?
So, John, I think that the three sectors in the United States that dominate the market, tech, consumer discretionary, and communications, are still about 45% of the U.S. market. And it's funny that people portray me as being so bearish. I just don't like those three sectors. I think virtually any other sector in the United States, anything else around the world, I think even Chris alluded to this a second ago, anything else around the world is pretty much fair game. But the United States is alone in that we are so dominated by those three sectors. And I think that those three sectors are highly speculative. They still are. And in an environment where the Fed is tightening monetary policy, you pointed out that we're heading towards 5 on the 2-year. That's exactly what the Fed and what monetary policy is supposed to do. It's supposed to disintermediate the markets. It's supposed to disintermediate the economy so that more and more projects, more and more investments are not palatable, and we actually start hoarding cash. That's what the Fed is trying to do. It's finally starting to happen.
So, Richard, are you saying if I'm bidding up consumer discretionary, I'm fighting the Fed? Is that the bottom line for you?
I think that's absolutely right.
So,
I
Chris,
think that's absolutely right.
I remember a line from Chris Harvey a year or so ago, and Chris came out, and you'll remember this line, Chris. I think you said it's going to be like spring break for adults. If I look at the airlines right now, year to date, it still feels like spring break for adults, with American Airlines up 26, United up close to 40%, Delta up 17. Chris, can you speak to that still?
Yeah, so John, one of our themes coming in, and yes, I did say that statement. One of the themes coming into this year was services over stuff. If you look at how the consumer has spent over the last couple of years and how they have traditionally spent, it's been more about experiences than it hasn't been about goods. But there was just an amazing amount of dollars spent on goods. That's beginning to slow down. We expect that to continue to slow down. And now what the consumer is going to do is they're going to spend his or her dollars, whether it's on trips and travel. Our gaming analyst who just came back from Vegas, he said the tables were packed, the casinos were packed. If you talk to people, they'll tell you that restaurants are packed. And again, the economy's okay. People are spending their money. This is very different than 07, 08, where we're talking about whether people are going to give the keys back to the house. Here, what we're saying is, how much of their excess savings have they already plowed through, and how much more can they before they slow down or they stop their spending? So we think the services side is still okay. It's the good side that we really don't like. And here's the funny thing. The weather is getting warmer. Spring is coming earlier. And so we could get a little bit of pop, and we are seeing a little bit of a pop from weather, whether it's here or it's overseas in Europe.
So, Chris, when you hear Richard say things like being long services, and I put those words in his mouth, is that like fighting the Fed? He said yes. Chris, what would you say back?
No, I don't think fighting the Fed. So a couple things about the Fed. One, let's remember the Fed was buying bonds 1 year ago today, right? Two, and you pointed this out a few times, and Richard pointed this out a few times. If you got to 5%, what you would expect is the economy to be in a much more difficult spot than what it is today, right? What we're seeing is the systemic risk is not where it was in 07, 08. The systemic risk is not where it was in 2000. And that's very important. The consumer will spend as long as he or she has the capacity to. And they're going to spend more on the services side than on the goods side. At some point, that will change. And again, we're not positive. We're positive on the services side of the consumer. We're not positive on the goods side of the consumer. We think that game is over. That game is done. But the consumer still has the capacity, and this consumer will continue to do that. And those are the trends that we're seeing.
That's the equity market. I just want to finish with the bond market. Richard, there's a lot of people out there who haven't looked at this bond market for a long time because it wasn't worth looking at for them. We're talking about zero on a 2-year, only back in 2021. And now they're confronted 490 on a 10-year north of 4%, a 30-year north of 4%, and even on a 6-month T-bill a 5 handle. Now, Richard, I understand that this will differ for different people. They'll have different circumstances, but I think the ultimate risk we need to discuss is reinvestment risk. Richard, do you suggest people do take on that 6-month T-bill and then in 6 months revisit this, face that reinvestment risk of maybe taking that money and reinvesting it again? Or do they lock this in for a long period of time? What are you advocating for?
So John, I don't think there's anything wrong with raising cash at this point in the cycle, right? I mean, our industry doesn't like that, but I think that's, when you're talking about 5+% cash rates, there's probably nothing wrong with doing that, given that equities, in any 1 year are expected to return somewhere between 6 and 8. So clearly there's some kind of risk return trade-off there. That's not the point. The point is that what investors invariably do is they fall in love with cash, and then they miss the opportunity on the other side when the bull market starts again, when the Fed starts easing, when the yield curve starts steepening. People at that point in the cycle usually say the Fed is impotent and can't reignite the economy. We're not even to the point where we've had a recession yet, but I think that there's nothing wrong with holding cash, is that you fall in love with cash. One has to remember that cash is always something you date, you do not marry.
Richard, I don't think you asked the question, though. Are you saying, given that you think there's reinvestment risk or not, should you take on the 6-month or the 10-year? Now, you think this is a new regime. If I hear new regime, then ultimately inflation's sticky, rates are staying high. Why take the 2-year? I can take the 2-year for a little bit and then just wait and come back and do the same again. Is that what you're suggesting?
Yeah, John, I didn't mean to skirt your question. I'm not a politician. I'm sorry about that. But I think you can play either end of the curve right now. I think the unattractive part is the center, the belly of the curve. If you're out at the long end of the curve, you're basically making the bet that the Fed will ultimately make a mistake and we will have a hard landing, which is typical. That's what history would suggest. If you're at the short end of the curve, you're saying that we're not done raising rates and we're still going to get higher rates. So I think the unattractive part of the curve is actually the center, the belly of the curve.
Interesting. It's financial TV. You know the rules. People answer their own questions all the time, Richard. Richard Bernstein, Chris Harvey, sticking with us. Let's get you some stocks on a move ahead of the opening bell. Here's Abby.
Hey, John. Well, just moments ago, we had headlines crossing the Bloomberg terminal around Blackstone that they have defaulted on €531 million of commercial mortgage-backed securities. Those were backed by Nordic offices and stores. Now, they were looking for a potential sale, but that didn't happen or hasn't happened yet. The servicer declared default. The loans now been transferred to a special advisor. That stock down 2.8%. Of course, this comes after Blackstone, the B-REIT, restricted a 4th month of how much can be redeemed by those wealthy clients. They tried in February for $3.9 billion. So obviously, this rates environment that you all are discussing really affecting Blackstone and the real estate picture. Turning to some other movers on the day, Salesforce is sharply higher, the best day since June of last year, I believe, after their 4th quarter results were much better than expected. The outlook was very strong, a good view for the operating margin in particular. Could see help free cash flow growth of 20%. Macy's also sharply higher, up 6.4%, a big contrast to Kohl's. They put up a big quarter in terms of a 20% beat for profit, and their comps were up 3% after 2 quarters of declines. And then finally, not so much down for Tesla. As you know, that investor day, a little bit disappointing. The stock down 7.8%. Investors had hoped for the introduction of new models. That didn't come, of course, into today. The stock up 65%. Price for perfection, they didn't get it. Easing back a little bit this morning.
Abby, thank you. Coming up, it's the Senate versus the White House.
Republicans talk about their love of free markets, small government, and letting the private sector do its work. The Republican bill is opposite of that.
That conversation up next.
now? Why'd you do this project?
Yeah, YouTube is this kind of a sleeping giant in social media. Someone described it as like this iceberg that no one ever really talks about as much for a variety of reasons. I see YouTube as both the past and now future of social media, and it was the first company to pay online broadcasters and invented the creator economy. And now we're seeing with TikTok, Instagram, Snapchat, are all moving in this direction. Social media is no longer your friends and family and your acquaintances. It is influencers. It is celebrity. It is a game built around commerce. And this is a world that YouTube very much created.
Should we be telling Odd Lots listeners to like, comment, and subscribe? Other podcasts do that.
I mean, it's an effective call to action.
All right, everyone, like, comment, and subscribe on Odd Lots wherever you find it.
Republicans talk about their love of free markets, small government, and letting the private sector do its work. The Republican bill is opposite of that. It forces MAGA Republicans' ideology down the throats of private sector and handcuffing investors as well.
It's an ESG showdown between the White House and the Senate passing a measure to block the administration's so-called ESG investing rule. The resolution set to force President Biden to use his first presidential veto. The state of Texas making its own move, planning to grow the state's divestment list comprised of firms that boycott the oil and gas industry. The Florida governor, Ron DeSantis, having his say in the Wall Street Journal, writing the following: ESG provides a pretext for CEOs to use shareholder assets on issues like reducing the use of fossil fuels. ESG is a way for the left to achieve, through corporate power, what it can't get at the ballot box. AMH has more. Anne-Marie.
Hey, John, what you're seeing right now, as you called it, an ESG showdown, and Republicans in Washington, D.C. are really heralding this as their fight against, quote-unquote, woke capitalism. And now this sets up President Biden in his first veto of his presidency. You mentioned Governor Ron DeSantis, this op-ed in the Wall Street Journal. Well, to counter that, we had Senate Majority Leader Chuck Schumer also taking the Wall Street Journal. He writes, if the market naturally leads to consideration of ESG factors, then Republicans should practice what they've long to preach: get out of the way. What you're seeing is for every Republican talking point, there is a Democratic pushback. And now this is bleeding into the state level. You've mentioned the Texas comptroller. Well, to pivot off of him, you have the New York City comptroller saying the complete opposite. He's actually reassessing to make sure that these firms are actually doing more when it comes to ESG. So what you really see is a difficult landscape for these banks and these firms to really navigate the politics, especially going into 2024, because Ron DeSantis didn't just talk about this in a Wall Street Journal op-ed. He's taking this nationally, and he wrote a lot about it in his book. So this is going to be a 2024 talking point.
Anne-Marie, do you think these financial institutions will just get squeezed from both sides then, going through the next couple of years?
I mean, you said it best earlier, not to steal a line from you, but you said it, they're in between a black rock and a hard place. They're getting pushed from both sides, from the Republican and states like Texas. They're really being ostracized. And then places like New York are saying, we want you to see you do more. So a lot of how these firms are going to have to navigate the landscape is going to become what it seems like a more state-by-state basis, whether it's blue or red, or maybe somewhere in the middle, purple.
MH, sounds better when you say it. You can have that headline, put it in a story or something. Anne-Marie, down in Washington, thank you. Coming up the morning calls and later, from Wall Street to the C-suite, the bullish oil crowd starting to get louder. That conversation still ahead with Alpine's Sarah Hunt. That conversation coming up shortly. Futures lower. We're down 0.6 on the S&P.
thinking big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Away from the opening bell, equities down about 0.6%. Let's get you some morning calls. First up, Barclays downgrading Neo to equal weight after earnings, pointing to the company's low margins and higher spending. Needham upgrading Salesforce to buy 230 price target, highlighting its new buyback plan, a surprisingly upbeat forecast. That stock's flying, up 16%. And finally, JP Morgan downgrading Dollar Tree to neutral, expecting limited upside as the retailer boosts its spending amid heavy competition. That stock negative by 2.9%. Coming up, Alpine, Sarah Hunt, seeing opportunities in energy as Chevron joins a growing chorus, getting bullish on crude. That's next, your opening bell, just around the corner.
And says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
So you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
This month, Bloomberg brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. Coverage begins next week on Bloomberg. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
From New York City this morning, good morning, good morning. Equity futures negative 0.5% on the S&P. On the Nasdaq down about 0.9%. Equity softer, lighter, lower, negative in the face of much higher bond yields once again. The data in America just really, really strong, and it's shaking things up big time. There's the opening bell. Switch up the board and get to the bond market. The whole curve, 2s out to 30s, north of 4%. Your 10-year piece yields up 8 basis points, 4.07% in the last 24 hours, north of 4% for the first time since November. On a 30-year, 4.03%. On a 2-year, the low of the year, early February, intraday, 4.03%. You can add 90 basis points onto that in a single month. 4.93 on a 2-year, up 5 or 6 basis points. Euro dollar just south of 106. We break that level this morning. 105.98. We're negative 6 or 0.7%. Inflation out of Europe, core CPI, all-time high. And we've done this without a big rally year to date in crude. Crude right now, just about stable, in and around 78 on WTI. About 40 seconds into the session, let's get you the early moves. On the S&P right now, we are negative 0.4%. On the Nasdaq, we're down about 0.8%. One stock to watch at the open, it's Macy's, shaking the retailer gloom. The CEO writing this: we were competitive, but our measures in our promotions took strategic markdowns and intentionally did not chase unprofitable sales. With more, here's Abby.
Hey, John. Well, on this, we are looking at a very strong day for Macy's, the best day since January 11th. At the highs, the best day since November 17th. So investors really rewarding Macy's. A massive beat for adjusted earnings, almost by 20%. We had a small miss for sales, but relative to comp sales, up 3%. This after 2 quarters of declines. So investors encouraged Bloomingdale's and Bluemercury really doing well, boosting growth. Now, relative to the comp sales, if we go into the Bloomberg terminal, we again are going to see a move to the upside after 2 downticks on a quarterly basis. So investors liking the fact that as we have other retailers, such as Kohl's, going in the wrong direction, Macy's is turning the ship around, and particularly their inventories. That was a big focus last year. Now, because of the unevenness in terms of what they've been able to produce, but again, coming through this holiday season really pretty well after having taken sales guidance, if you recall, down in January because of December weakness. So it seems as though shoppers are out a little bit in January, not the typical. This stock is basically range bound over the last 9 months, up and down, as investors trying to figure out what's next. Over that time period, down about 6%, John. But it's so interesting to see what Macy's was able to do relative to Kohl's. Clearly a step ahead.
Abby, thank you. Different story for Best Buy, delivering a disappointing outlook similar to its peers at Walmart and Target. The CFO saying this: the consumer electronics industry continues to feel the effects of the broader macro environment and its impact on consumers. Katie Greifeld with us with more. Hey, Katie.
Hey, John. Well, you're right. There is a lot of daylight between what we heard from Macy's and what we heard from Best Buy. You currently have shares under pressure this morning, down about 4% or so as trading kicks off after Best Buy became just the latest retailer to deliver a gloomy outlook as consumers step away from those discretionary purchases. Specifically, Best Buy predicted that sales are going to fall for a second straight year. You have revenue forecast to drop between $43.8 billion and $45.2 billion. That's below the average analyst estimate. Meanwhile, 2024 adjusted EPS, it's seen between $5.70 to $6.50. The midpoint of that range, as you can see on the chart, that would be the second straight annual fall as well. And today's weakness comes after a pretty strong rally for Best Buy. They're up about 30% or so from October's lows. But what I think is poetic about this chart, John, is that Best Buy is virtually unchanged since the start of 2020. You have that boom and that bust. But again, if you just look at the shares, it's like the pandemic never happens.
Katie, thank you, except it kind of did, as we all know. But maybe not there. Katie, thank you. We appreciate it. Equities right now on the S&P more broadly, about 3 or 4 minutes into the session. Your equity market looks like this on the S&P. We're down about 0.5%. Outside of that, on the Nasdaq, we are lower by 0.8%. Want to catch up with Tesla. Shares falling. The company's investor day missing the mark. A 4-hour long presentation that was short on details.
And I'd love to really show you what I mean and unveil the next gen car. But you're going to have to trust me on that until a later date. And I promise we'll always be delivering exciting, compelling, and desirable vehicles, as we always have.
Ed Ludlow on the West Coast with more. Hey, Ed.
Yeah, good morning, Jonathan. It wasn't so much what they said, it's what they did not say. You look at the shares down 7%, biggest drop since January 3rd, and $50 billion of market cap shaved off. You and I discussed 24 hours ago that the expectation this would be a sell the news event came true. You know, some of the highlights were a confirmation that Tesla's next gigafactory will be in northern Mexico, in Nuevo León, in Monterrey, but no details on the timeline for construction. A lot of focus from sell-side analysts on the lack of detail on next-generation cars. As you heard in that clip from Franz von Holhausen, who's the design chief, they have plans for a mass-market car. Tesla did say they will target a 50% cost reduction, but that was it. There was no detail on timing. We do know that it will be built in that Mexican gigafactory, but no pricing, no design, just a classic Tesla slide in a PowerPoint which showed all their existing vehicles and the 2 future vehicles covered by a tarp, wink, wink. You look at that board there, what they did say is that in their next drive units, they're moving away from rare earth metals. That is hitting some of the miners, also moving away from silicon carbide chips. The visual really was Elon Musk with 16 executives sat behind him on stage, John, and that was a pretty pointed demonstration by Tesla that there are people at that company running it outside of Elon Musk. As you know, that was one of the complaints of Ross Gerber, who recently abandoned an activist bid for a board seat because people want to know if Elon Musk is kind of still a key man risk for that stock.
Ed, appreciate it, mate. Thank you very much. Ed Ludlow on the latest with Tesla. Dan Ives of Wedbush sees good things. That wasn't a consensus, but here's a bullish take for you. While there were no specific details for the lowered price next-generation Tesla, which will cause a knee-jerk modest sell-off this morning, the stage is set for this car to be produced and scaled globally. We came away very impressed by the Tesla Foundation and Musk vision for the next decade. That's one take at least. That stock is down by 7.5%. Let's talk crude. The bullish energy crowd is starting to grow louder. Goldman's Jeff Currie expecting a spike in crude prices over the next 12 to 18 months.
Manufacturing data coming out of China is some of those green shoots we need to see to get the bull story ramped back up again.
The Chevron CEO, Mike Wirth, speaking to Alex Steele, getting behind that bullish view.
All the leading indicators would suggest that economic activity is picking up, energy demand is picking up, and I think as we get into the middle of this year and certainly into the second half of this year, that demand is likely to tighten markets a little bit.
Happy to catch up with Sarah Hunt of Alpine. Now, Sarah, wonderful to catch up with you once again. I know you like the opportunities in this sector. Run us all through it.
So I think that there are 2 different parts to this story, right? One of them is the oil story, which I agree with. If you are starting to see China really start to move, that's something that people have been looking for. You have a decade's worth probably of underinvestment because of the thesis that we were going to get away from hydrocarbons. So on the oil side, that's a transportation story. So all this, the fact that the airlines are doing very well, part of what's helping them has been lower oil prices. But if you start to see oil prices come up, that's going to impact their earnings. If you look at the natural gas side of things, which we look at very much for Europe, I think there's a story in LNG, and I think you've got a couple of different pieces to that. One of them is the actual producers of LNG, which is companies like Cheniere. And other companies are the ones that play into that infrastructure, which is something like Chart Industries that recently made an acquisition that's going to be very good from an industrial standpoint, but people weren't happy about the financing. So you now have a chance to look at that stock at a lower level than you did for the last year or so.
Sarah, in relative terms, there was a spread that opened up between some of the energy players in Europe and the energy players in the United States. Perhaps the windfall tax was part of that. Can you run us through why you think that was and why maybe that closes this year?
Well, I think there's an investment part of it and there's a tax part of it, right? So there's whether or not companies are making those investments and whether or not they can get product to actually get it to market. And I think the concern over the windfall tax was very real. And if you look at years of companies who have had problems when you had low commodity prices, not getting any subsidies, but now being asked to pay more and being basically castigated for buying their stock back instead of investing more, when a year ago or 2 years ago they were being told that oil was going away and you shouldn't be investing. I think it's a very tough place for those, very tough for those companies to navigate the political and geopolitical issues that are going on with oil. But I think that the fact that we're not talking about having that tax does help. And I also think that in Europe you've got higher taxes anyway, so it's a combination of things. in the spread between those two areas.
It's tough to navigate this equity market right now. The S&P's down 0.6, the Nasdaq's down about 1 full percentage point. You've seen this big move in the front end. The 2 years now 493, pushing 5%. I know you watched this interview yesterday, Sarah, so I just took a snapshot of it for us both to listen to. This was David Page of AXA. Take a listen.
The move that you would get if you followed a Bullard type approach is much more consistent perhaps with Fed history, that you could see the rates move a little bit higher to peak, maybe, you know, even towards a peak of 6%. But then once you reach that, you would break the economy. You would have to see rate cuts follow quite quickly.
Now, Sarah, everyone's going to be right eventually, but they set it at 3, nothing broke, 4, 5, and now we're talking 6.
So here's something that I find interesting about that. If you think about whether or not we were all underpricing what the Fed was going to do, which arguably if 3 was the limit, we were underpricing that 6 months ago. I wonder now if 6% is starting to overprice a little bit, although, you know, maybe we could get up to touch there for a period of time. I think really the biggest thing that stood out to me from what he was talking about yesterday was you're using backward-looking data for forward-looking action, which is raising rates. And I think that's the most difficult thing. I mean, I know that you guys earlier this morning were talking about the whole long and variable lag issue and whether or not that has any meaning and whether or not that's an older statistic. But I do think that there are parts of the economy for which those changes don't happen so quickly. And very often, like a lot of contracts are priced yearly. A lot of things happen on a not quarter-to-quarter basis. And Wall Street is so used to focusing on the quarters that we lose sight of the fact that, you know, wage negotiations don't happen every time the Fed changes rates. It happens once a year or once every couple of years, depending on the industry. So I think that there is an argument to be made that some of the effects are not being seen yet. But I also think you're starting to see some issues in the lower credit markets. You're seeing subprime auto, you're seeing some of the subprime credit card start to see more charge-offs. And I think that's a sign that things are getting tougher, especially on that lower end.
We got this headline in the last hour as well, that Blackstone has defaulted on a €531 million bond backed by portfolios of offices and stores. Are we going to see more of that, do you think, Sarah?
I don't see how you repurpose some of that. It's such a big argument right now, and I don't see how you can repurpose some of those buildings, but I think you absolutely are, because the idea in the original going back to work out of the pandemic was that people were going to go back to a regular schedule. I think 3 years has really changed that, and I think that no matter what you see about companies asking people to go back and some people going back 3 days or 4 days, you're not going to have the same occupancy that you had in a lot of those major metropolitan areas in the less than A-class buildings. I don't think the A-class buildings have a problem. I think everything below that is going to have a problem, and it's going to take some real creativity to figure out how to repurpose some of that space. And I know New York specifically is having an ongoing discussion about that because we have so much a lack of housing, but we now have so much empty office space. But I think that that is really going to continue to be a challenge on the commercial real estate front.
Sarah, this was great. It always is. Sarah Hunt there of Alpine Saxon Woods. Here's the broader market for you. About 12 minutes into the session, equities lower by 0.5% on the S&P. On the Nasdaq, we're down by 0.75%. This equity market has to confront what's developing in this bond market, and once again, its yields up, a lift right the way through the curve. 2s out to 30s, every single point across the curve with a 4 handle this morning. On a 30-year north of 4%, on a 10-year north of 4%, on a 2-year approaching 5 at 4.93. Up next, the push for private credit.
Your regular way direct lending deal, 12 months ago, was made in probably a little bit more of a frothy market these days. Today it's as lender friendly as it gets.
We'll get the latest from Oaktree up next.
most actors are thrilled if they have one part like Rocky in their whole career.
Yeah.
You had another one, Rambo.
Yeah.
Now, Rambo was not something you created, is that right?
No, Rambo was a novel by David Morrell, and I was the 11th choice. Everyone, it was like, I don't know who was next after me because they had gone through everyone, and it passed, including 3 different directors. So this had become sort of a pariah of sorts. The first time we go in there, Rambo was, in the original screenplay, was horrible. He was a psychopath. He killed children, he killed fishermen, this and that. So I said, if I'm going to get involved with this, I see the character going on beyond this. And he said, what do you want to do? I said, I want to rewrite the screenplay. And I want him to go right to the edge of violence, right to the point where he's being pushed, but he pulls back because, similar to James Dean in East of Eden, he wanted to be accepted back into the family of man.
So if Rambo got in a fight with Rocky, who would win?
Rambo.
Rambo.
Easy.
Because
not even a fight. Unless it's in a ring. See, first of all, Rambo is a killer, for real. He's almost a psychopath when that switch flips. Rocky is a good guy. You know, he has mercy. The other one has no mercy.
The top names in business are on Bloomberg.
I think the future of autonomy is real for civil. It's going to take time. Everyone's got to build confidence. We need a certification process that we all have faith and believe in. As you may know, we have an application on an all-electric autonomous airplane we refer to as WISC. There's so much to learn, so much to do, but it is being done.
Nobody covers business like Bloomberg, your global business authority.
Your regular way direct lending deal, 12 months ago, was made in probably a little bit more of a frothy market these days. Today it's as lender friendly as it gets. With where base rates are, with where spreads have moved, I mean, spreads are at least 100 basis points wider, sort of year on year. You're probably able to earn 12% on your regular way direct lending deal for a quite good company, probably 50 LTV loan. I think that's really attractive. That's probably 400 or 500 basis points wide of where you were sort of a year and change ago.
Makes it sound easy. Double-digit returns, a growing void left by the big banks, fueling appetite for private credit. Some of the largest private lenders raising billions of dollars around the world to seize the opportunities. Oaktree making its move, looking to fill financing gaps in LBO lending with a $10 billion fund. I'm pleased to say that Oaktree's Armin Panossian joins us right now. Armin, wonderful to catch up with you, sir, as always. Let's start here. New entrant, why?
It's a very exciting time in the credit markets with the volatility we've seen in equity and credit, as well as the banks stepping away from the private credit markets. We believe that it's the most attractive time that we've seen in several years in private credit to originate first lien loans to private equity sponsors doing new deals at very low loan to values and very attractive returns. And Oaktree, just given the fact that we've been in private credit for actually 20 years, not so much as heavily in the large cap sponsor lending market, but we have the capabilities to really lean in heavy right now, and the benefit of not having any legacy portfolio issues that would shackle us. So we're moving in with a lot of conviction right now with a very large fundraise.
And that last point I think is really important. What are the advantages of not having those legacy policy issues, as you pointed out, legacy portfolio issues?
Unfortunately, over the last several years, there was some excessive lending practices, both in broadly syndicated or tradable loans, as well as in direct lending. That was reflected in tighter pricing than what we're seeing in the market today, a loosening of covenants, and fairly high loan to values in newly originated debt. Today, on all 3 of those metrics, it's more lender friendly. We're seeing spreads on newly originated loans 100 to 150 basis points wider just over the last 12 months. We're seeing base rates, SOFR, the standard overnight rate, up from roughly 1% a year ago to now over 4%. And then in terms of loan to values on new deals, routinely we would see 60 or 65% loan to values on new leverage buyout transactions a year ago. And today it's more like 40 to 50% with better legal protections as well in the form of covenants.
So, Armin,
if you don't have
Sorry to jump in. No, please. I was just thinking, are you saying that this is getting more attractive for a lender at a time when traditional lenders are actually pulling back?
Yes, it is. The traditional lenders have legacy portfolios that are higher in loan to value, lower in price versus what is the current market. And I think there's some cracks in the economy that are showing up in portfolios that are giving them reason to pause, which is creating the opportunity for a large new entrant that is able to navigate through landmines.
Can you give us an idea of the average coupon size? And I know this is difficult because you guys go bottom up across a range of industries, different places, but can you give me an idea of what's on offer here at the moment?
First lien private credit is being priced at about SOFR plus 6.5%, which lands at about a 12 to 12.5% coupon rate on those loans.
Looking at what's happening in traditional fixed income at the moment, with a 2-year at 4.90 and a 6-month T-bill at 5%, how competitive do you think this actually is historically?
I think it's better than what it has been historically, and I think the relevant comparison is if you look at the best 80% of the tradable credit market in below investment grade, and you compare it against newly originated private credit in today's market conditions, you're picking up about 300 to 400 basis points of spread or return in going to the private markets. So that's really the relevant comparison, and we find it to be attractive, incredibly attractive relative to the last 5 to 8 years.
And a lot of the time on this program, we spend a lot of time doing macro, top-down stuff. I know for you guys, traditionally, it's all bottom-up, it's quite micro. Within industries at the moment, are you seeing lots of dispersion, lots of opportunities away from the macro stuff?
Within industries, yes. There are certain industries that benefit from inflation. There's some opportunities there. There are other industries that there are leading positions or leading companies that are able to defend their EBITDA margins or their cash flow margins even through volatile economic and market conditions. And when there is volatility driven by market technicals, that creates an investment opportunity for fundamental investors like Oaktree.
Can we talk about landmines? Sometimes in this business, as you know, it's not what you choose to own, it's what you choose not to own. What are you avoiding?
We're avoiding sectors and businesses that have very tight cash flow margins, companies that are not able to pass through cost increases to their customers without demand destruction. Obviously, traditional retail is problematic given that backdrop. Certain types of real estate are seeing cracks as well, especially in the office space. I know your previous speaker spoke about that. But we're more focused from a bottoms-up perspective on the quality of earnings and the quality of businesses' capabilities to weather through downturns by very active cash flow management.
Do you see the risk of a situation where some of these landmines blow up and cause issues in places where they shouldn't, that people have to sell their stronger hands to cover their weaker ones? Do you see a situation like that potentially developing?
It's possible, but that type of risk was more apparent during the global financial crisis when there were vehicles that did not have matched assets to their liabilities. They had short-term liabilities with long-term assets, and it caused them to sell their best positions to really shore up their liquidity. That's not really the case right now. There really isn't mismatched assets and liabilities. So investors should be able to weather the storm and hold on to their best assets if they don't have meaningful outflows that they need to supply liquidity for.
And let's do this more often. This was a clinic, an education, as it often is. Armin Panosian there of Oaktree on their latest effort. Equities right now down a little bit. No real drama here. Down 1/3 of 1% on the S&P. On the Nasdaq, we're down about 1/2 of 1%. In the bond market, yields are higher. Talked about that through the morning. The data really pretty tremendous. Looking at jobless claims, there are no signs, at least at the headline level, of cracks in this labour market. I know beneath the surface, there's lots of pockets of weakness here and there. Tech, parts of finance, banking, etc. But yields on a 2-year, remarkable 4.93. Up next, your trading diary.
back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip, a bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
26 minutes into the session, equities down by about 0.5% on the Nasdaq, down by 1/3% on the S&P 500. In the face of this, in the bond market, yields up right across the curve. 2-year 4.90, 10-year 3.4, 10-year 3.4%, and a 30-year as well. That's the price action. Let's get you the trading diary. Coming up, more retail earnings. Costco, Nordstrom after the bell. Fed speak. Waller, Kashkari, Logan, Bostic, Bowman to round out the week. Eurozone PPI data out on Friday, plus President Biden meeting with the German Chancellor Olaf Scholz at the White House. From New York City, that does it for me. Thanks for watching Bloomberg TV. This was the Countdown to the Open. This is Bloomberg.
Why'd you do this project?
Yeah, YouTube is this kind of a sleeping giant in social media. Someone described it as like this iceberg that no one ever really talks about as much for a variety of reasons. I see YouTube as both the past and now future of social media, and it was the first company to pay online broadcasters and invented the creator economy. And now we're seeing with TikTok, Instagram, Snapchat, are all moving in this direction. Social media is no longer your friends and family and your acquaintances. It is influencers. It is celebrity. It is a game built around commerce. And this is a world that YouTube very much created.
Should we be telling Odd Lots listeners to like, comment, and subscribe? Other podcasts do that.
I mean, it's an effective call to action.
All right, everyone, like, comment, and subscribe on Odd Lots wherever you find it.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in five stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we had mounted our own campaign, even in the U.S.
He flew to America and he hired 2 consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard, In America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. and it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because